dalam pengembangan sumber daya manusia sektor jasa keuangan secara berkelanjutan, guna mendukung terwujudnya industri jasa keuangan yang stabil, kontributif, dan inklusif. Kami sadar, dalam mewujudkan visi tersebut, peran SDM yang unggul dan kompeten menjadi kunci utama. OJK Institute hadir untuk menjadi Center of Excellence, guna mendukung pengembangan sumber daya manusia sektor jasa keuangan dan melakukan riset-riset yang inovatif dan terkini. Pengembangan sumber daya manusia sektor jasa keuangan yang kompeten dan profesional menjadi salah satu faktor penting dalam mendukung keberhasilan kinerja lembaga jasa keuangan. OJK Institute memiliki 3 fungsi utama. 1. Mengembangkan kapasitas SDM sektor jasa keuangan melalui penyelenggaraan program pelatihan, seminar, dan workshop. 2. Melakukan riset yang inovatif dan visioner. 3. Merancang dan mengembangkan standar kompetensi SDM sektor jasa keuangan, serta melakukan penata laksanaan lembaga sertifikasi profesi. Dalam rangka meningkatkan kompetensi SDM di sektor jasa keuangan, OJK Institute menyelenggarakan berbagai program capacity building, baik dalam bentuk workshop ataupun webinar. Menghadirkan narasumber terbaik yang memiliki keahlian di bidangnya, antara lain bidang perbankan, pasar modal, IKNB, teknologi digital, dan lain-lain. Riset di OJK Institute berbasis akademik dengan memperhatikan perkembangan terkini. Penyusunan riset menghasilkan temuan dan rekomendasi yang mendukung kinerja sektor jasa keuangan. OJK Institute juga menyediakan perpustakaan digital e-library OJK yang mengelola koleksi buku digital, koleksi internal OJK, koleksi buku fisik, dan koleksi e-resources mitra OJK. Selain itu, manfaatkan juga aplikasi e-lib OJK untuk membaca e-book melalui smartphone. Minisite OJK Institute tersedia sebagai portal media digital untuk mempermudah publik mengakses berbagai informasi kegiatan OJK Institute terkini. Selain itu, OJK Institute juga membangun knowledge management system sebagai media pembelajaran dan pertukaran knowledge secara digital yang dapat diakses oleh seluruh SDM sektor jasa keuangan. Indonesia saat ini telah menerapkan strategi pengembangan SDM berbasis kompetensi. OJK Institute bekerja sama dengan instansi-instansi terkait dalam menyusun suatu standarisasi kompetensi yang disebut dengan SKKMI, yang kemudian diturunkan menjadi KKMI. SKKMI dan KKMI dimaksud digunakan oleh lembaga sertifikasi profesi atau LSP dalam penyusunan skema sertifikasi, pengajuan rekomendasi, dan pengajuan pendaftaran ke OJK. Selain 3 fungsi utama tersebut, OJK Institute juga berfungsi sebagai license officer, praktek kerja lapangan, visit OJK, penelitian mahasiswa. OJK Institute memfasilitasi program praktek kerja lapangan di lingkungan OJK bagi pelajar dan mahasiswa. OJK Institute juga menerima kunjungan lembaga pendidikan yang ingin memperluas wawasan bidang tugas dan fungsi OJK serta sektor jasa keuangan. Selain itu, OJK Institute senantiasa memfasilitasi mahasiswa dalam hal penyediaan data atau informasi terkait dengan tugas dan fungsi OJK. Dalam rangka mendukung pengembangan SDM sektor jasa keuangan, OJK telah menerbitkan Cetak Biru Pengembangan Sumber Daya Manusia Sektor Jasa Keuangan 2021-2025 pada 25 Mei 2021. Cetak Biru tersebut memiliki visi, yaitu mewujudkan SDM sektor jasa keuangan yang profesional, berintegritas, dan berdaya saing global dalam rangka meningkatkan kinerja sektor jasa keuangan. Visi tersebut dijabarkan dalam 4 pilar misi, yaitu 1. Mengembangkan standarisasi kompetensi SDM. 2. Mengembangkan metode peningkatan kompetensi SDM. 3. Mengembangkan infrastruktur pendukung pengembangan SDM. 4. Mengembangkan SDM yang memiliki kompetensi digital. Implementasi Cetak Biru ini kemudian dituangkan ke dalam 21 program kerja yang akan dilakukan dalam kurun waktu 5 tahun dengan melibatkan peran aktif dari industri, akademisi, OJK, dan lembaga lainnya. OJK Institute memiliki komitmen yang kuat untuk melaksanakan cetak biru tersebut bersama-sama dengan pengawas, industri, akademisi, dan pemangku kepentingan lainnya. Cetak biru tersebut diharapkan menjadi kerangka acuan dalam mendukung pengembangan SDM sektor jasa keuangan. OJK Institute, Center of Excellence.
Ya, Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, ladies and gentlemen. Before we begin this event, allow me to inform you several guidelines during this session. First, you may type your questions after our panel session via the Q&A feature by mentioning your name, followed by institutions, and the name of the speaker you are proposing your questions to. All the questions can be submitted in English and Bahasa Indonesia. Semua pertanyaan bisa Anda tuliskan dalam bahasa Inggris ataupun bahasa Indonesia because we provide the interpreter feature, and please select the language that you prefer or suitable the most. Thank you, and we really hope you enjoy our discussions today. Assalamualaikum warahmatullahi wabarakatuh. Good afternoon, salam sejahtera, Om Swastiastu, Namo Buddhaya, salam kebajikan. Before we start, I'd like to sincerely greet our distinguished speakers and guests. First, Chairperson of the Audit Board, concurrently member of the Board of Commissioners, Ibu Sofia Watimena. Good afternoon, Ibu Sofia.
Good afternoon.
And also Head of OJK Institute, Bapak Agus Sugiarto. Good afternoon, Pak Agus.
Selamat siang, terima kasih Pak.
We also greet the Director of Financial Services Sector Development, Bapak Hikmah Rinaldi. Selamat siang, Pak Hikmah Rinaldi.
Selamat siang.
Yeah. And our partners and speaker from the London Institute of Banking and Finance, we have Mr. Nicholas Wood, Mr. Ahmad Dixit, Mr. Lim Eng Ai, Mr. Karwi Ang, and Ms. Lee Jing Tan. Good afternoon, everyone.
Selamat siang, terima kasih.
Selamat siang.
Selamat siang.
And I would like to also greet the leaders and employee of Otoritas Jasa Keuangan, leaders of Financial Services Industry, Financial Services Industry Association representative, distinguished guests, ladies and gentlemen. Welcome to the role of GRC in supporting financial sector performance webinar. Thank you for your enthusiastic, and before we start, please give huge round of applause for today's event and to all of you that really enthusiastic to join our webinar in this afternoon. There are already 2,897 people who registered to join this webinar. The majority comes from the banking sector with 45.67%, the non-bank financial industry 29.51%, others 7.56%, OJK 5.21%, academician 4.69%, the capital market sector 4.52%, government agencies 2.83%. Wow, this will be new highest records for LIBF webinars. And ladies and gentlemen, before we begin, allow me to run a quick brief of our agenda today. First, our webinar will be started by opening remarks by Chairperson of the Audit Board, concurrently member of the Board of Commissioners, followed by a presentation and discussions led by moderator, and also followed by question and answer session, and also the closing statement from our speakers at the end of our webinar. Distinguished guests, ladies and gentlemen, we are now opening today's event with the welcoming remarks by Chairperson of the Audit Board, concurrently member of the Board of Commissioners. Please welcome Ibu Sofia Watimena.
Thank you. Good afternoon. Assalamualaikum warahmatullahi wabarakatuh. Salam sejahtera, Shalom, Om Swastiastu, Namo Buddhaya, Salam Kebajikan. Bapak Iman Syah, Deputy Commissioner of OJK Institute and Digital Finance, Bapak Agus Sugiarto, Department Head of OJK Institute, webinar speakers and moderators, Mr. Nicholas Wood, from the London Institute of Banking and Finance faculty, Mr. Amor Dixit, founder and CEO of Sensum, Mr. Lim Heng Hai, CEO of Tech Create Solution, and Mr. Aldi Hawari, officials and employees of OJK, association leaders and representatives, officials and employees of the financial services industry, and all distinguished guests, ladies and gentlemen. It is grateful that we could attend the webinar with the topic of the role of governance, risk and compliance, or GRC, in supporting financial sector performance. I would like to offer my gratitude to all speakers, Mr. Nicholas Wood, Mr. Amor Dixit, Mr. Lim Heng Hai, also Kar Wee Ang, and Li Ying Tan from Singapore, who spend your time to share us your knowledge, and all the participants who are attending this webinar jointly organized by OJK Institute and London Institute of Banking and Finance. Ladies and gentlemen, in the recent years, the world has been exposed to an explosion of digital technologies that are fundamentally changing the way we live and work. The most recent innovation is currently known ChatGPT, artificial intelligence that can respond to almost everything with such precision as if we communicate with humans. With regards to the financial sector, the rapid digitalization forced financial industry to carry out digital transformation of their business processes in order to anticipate the wave of change in the industry. There are several risks and challenges of the governance implementation in Indonesia. Based on the Asian Corporate Governance Score, or ACGS 2019, Indonesia was ranked 5th out of 6 countries and was only better than that of Vietnam. The score indicated that Indonesia has been exposed to the potential of high-cost economy and eventually increased the country risk. Other challenges are related to the data governance and cybersecurity. With personal data protection law in place, financial industry faces great challenge to protect their consumer data. Data leakages are becoming more frequent. According to the Identity Theft Resource Center, there were more than 1,800 reported data leakages in 2022, exposing more than 400 million records, including sensitive information. Cybersecurity threats are also increasing. According to a report by Cybersecurity Ventures, cybercrime is expected to cost the world about $10 trillion annually by 2025, up from $3 trillion in 2015. This highlights the importance of having strong digital governance strategies in place to mitigate these threats. Moreover, with regards to the financial sector, we are aware of the newly approved law, the Financial Sector Development and Reinforcement, or P2SK Bill, which amongst others enlarged the area of OJK supervision authority. The role of digital innovation and governance is undoubtedly crucial to support this responsibility. Webinar participants, this is where GRC become crucial to ensure organizations manage their risks effectively, protect their stakeholders, improve transparency, and operate within the boundaries of applicable laws and regulation. GRC consists of three key elements: governance, which is the process of setting and monitoring strategic objectives; risk management, which involves identifying, assessing, and mitigating risks; and compliance, which ensures that the organization operates in accordance with applicable laws and regulations. The application of these three success factors cannot be separated and needs to be comprehensively integrated in the business process. There are a number of benefits that can be obtained by implementing GRC in an integrated manner. First one, continuous collaboration among the assurance functions, which in turn helps create a holistic risk picture. Second, accurate information regarding risks and controls that enable stakeholders to make quick and risk-aware business decisions. Third, an effective compliance program to address changes in regulation, technology, and business. And fourth, lower assurance or audit costs. Furthermore, we believe that through innovation in strengthening the integrated GRC, it would be able to detect potential risks or as an early warning system. As part of our effort to strengthen GRC in the financial sector internally, OJK has also implemented supervisory technology for integrated supervision to detect weaknesses both in the framework of prudential supervision and market conduct, which will be further developed on a broader scale. Therefore, OJK encourages financial industry to also implement integrated GRC through technological innovation, as it would assist in increasing revenue and market share, improve cost efficiency in a shorter time. In addition, technology innovation will have a role in identifying anomaly transactions which lead to risky transactions, such as illegal online loan and money laundering. Eventually, it will all lead to a stronger performance of financial institutions and to better serve their clients and all stakeholders. Distinguished guests, ladies and gentlemen, finally, I wish the webinar held by OJK Institute jointly with the LIBF will open up our horizon about how GRC evolved and its implementation for the financial services sector. I believe the distinguished and prominent speakers are going to share their valuable experience and broad knowledge of this emerging topic. Thank you. Wassalamualaikum warahmatullahi wabarakatuh. Om Santi Santi Santi.
Thank you very much, Ibu Sofia Watimena, for such a warm welcome and also the keynote points that will lead us to successful discussions on this afternoon. And to highlight, to quote your remarks today, GRC become crucial to ensure organizations manage their risk and protect their stakeholders. I assume there are a lot of stakeholders and on today's webinar, and this discussion will be fruitful for all of us. Thank you very much, Ibu Sofia Watimena. And due to attend another agenda, you may now leave the virtual room. Once again, thank you. Thank you very much to gracing us with your attendance and presence at this event today, Ibu Sofia.
Once again, thank you very much. All enjoy the webinar.
Thank you.
Terima kasih, Bu Sofia.
Terima kasih, Pak Agus. Terima kasih semuanya.
Distinguished guests, ladies and gentlemen, we will have question and answer session after our speaker's presentation. And I would like once again remind you that you may type your question and via Q&A feature by mentioning your name, followed by institutions and the name of the speaker you are proposing your questions to. And all the questions can be submitted in English or Bahasa Indonesia. And at the end of our session, we will also share a feedback form on the chat feature. So please note and complete the feedback form the latest by Friday, February 24th, as a requirements to get your webinar's e-certificate. Ladies and gentlemen, and now we would like to invite our speaker for today's event. Our first speaker, Mr. Nicholas Wood, LIBF APAC faculty. The next speaker for the panel session, we will have Mr. Lim Eng Ai, Chief Executive Officer, Tech Create Solution, and also Mr. Ahmad Dixit, founder and CEO of Zensang. You might be curious about our panel's milestone and background. So here they are. I would like to present you the CV or resume of our panelists. The first speaker is Mr. Nicholas Wood. Mr. Nicholas Wood, he is the CEO of Untuk, providing bespoke finance, risk, and treasury solution for financial institutions in emerging market and developing country. He is also advising tech startups on capital raising and international business expansion. Mr. Nick has 40 years of banking treasury experience, mostly in Asia, building highly profitable trading rooms and shaping business responses to capital and liquidity regulations. He has first-hand knowledge of managing name-specific and market-wide stress through multiple crises and multiple countries. And our second panelist or speaker is Mr. Eng Ai. Mr. Lim Eng Ai has more than 20 years of payment experience covering check transaction system and real-time high-volume, low-value payment systems. Through their collaborations, ASEAN Banker Association and Global ISO Financial Standard participations, Tech Create and team has been actively participating in real-time implementation globally and regionally. Tech Create is a Singapore-based fintech company with presence in Malaysia, Cambodia, Brunei, and specializing in helping financial institutions in the digitalization journey and the modernization of their payment infrastructure to support 24/7 payment requirements. He holds a Master in Science from University of Portsmouth, UK, and Bachelor in Business Studies from Nanyang Technological University, Singapore. He is also PMP certified. And the third speaker, we have Mr. Ahmad Dixit. He is founder and CEO of Zensang, a Singapore-based insurtech firm aiming to provide innovative, sustainable, and personalized artificial intelligence or AI-powered insurance solutions with a presence in Singapore, Indonesia, Malaysia, and India. Mr. Ahmad has more than 23 years of experience in financial services industry, where his last stint was with Standard Chartered Bank as MD, Head of Insurance and Investor Business for ASEAN region. He has earlier worked with Capco, PwC, and Citibank. He is also considered as a thought leader within the financial space, having authored multiple articles and participating in national and international industry bodies for the enhancement and standardization of financial services initiatives. He also serves as Singapore's representative in ISO 222. He earlier served as chair for E-Financial Services Committee under the Enterprise Singapore from 2015 to June 2020. Yep. Ladies and gentlemen, please give a huge round of applause to our panelists and our speaker of this afternoon session. And without any further delay, please welcome our speaker, our first presenter, Mr. Nicholas Wood. Good afternoon, Mr. Wood.
Good afternoon, Pak Aldi. Let me just share my screen. Give me one second,
please. Thank you very much
please.
for making the time, being our speaker for today's event. So, Mr. Wood, talking about the GRC to support financial institutions in Indonesia, what can you learn from Indonesians' advice market and customers that differentiate Indonesia to other countries?
Well, I'm going to go through that at length because I've got a lot of experience in Indonesia going all the way back to 1985 and going through multiple crises, as well as current coverage. So I'm hoping to bring out a lot of very relevant, practical examples and tips on how to navigate through some of the challenges facing the financial sector today.
Yeah, after the COVID-19 pandemic, there will be a lot of challenges that financial institutions in Indonesia will be or may be experienced due to the digitalization and so on. And I believe that your expertise will answer all the questions towards the GRC problems on today's event. Thank you, Mr. Wood. And after your presentation, Mr. Wood will also join the group of panelists and lead our panel session along with Mr. Lim Eng Ai, CEO of Tech Create Solution, and Mr. Ahmad Dixit, founder and CEO of Zensang. So, Mr. Wood, the room is yours now, please.
Terima kasih, Pak Aldi. Thank you. Excellent. Selamat siang. Thank you so much to Ibu Sophia, Pak Aldi. I'd like to especially thank OJK and of course Pak Agus and for all of the excellent coordination that's taken place with the LARBF to put this together. And thank you so much to everyone from OJK and other participants who have registered for this event. We'll try and make it absolutely worth your while. Okay, I really think this topic is critically important for delivering Indonesia's national ambition. And I had the honor of attending an event with the Indonesian FinTech Association in Bali in November of last year, and listened to a very inspirational speech by Pak Luhut, Coordinating Minister of Maritime and Investment Affairs. And he laid out Indonesia's Vision 2045, becoming a high-income country. And he emphasized how important the digital economy will be to reaching and attaining that objective, that vision. Indonesia's digital economy is already the biggest in ASEAN, and it's growing like crazy. It's expected to triple by 2030. And there is huge focus on micro and SME sector, where financial inclusion and access to finance and payments are key objectives. And so with more people coming into digitalized solutions, digital literacy also needs to improve at the same pace. It's been accelerated by pandemic imperatives, but there's more to do on getting the sector up to speed in terms of financial literacy. So my key statement is that to deliver this 2045 ambition, it will be critical that the financial sector has GRC resilience. It is key to that delivery. Now, here is my personal Indonesia GRC journey. It started in 1985-86 in a building I'm not even sure if it's still there. It was Wisma Antara in Jalan Tamrin. And it was with Bank of America, who I don't think are certainly not in that building anymore. And at that time, while I was there, the Indonesian rupiah devalued 30% after a long period of stability. I then came back to Indonesia in 1997 to 1999, this time treasurer of Standard Chartered Bank. It was a very turbulent time. It was the Asia financial crisis. And again, the rupiah devalued from 2,300 to 15,000 to the US dollar in 1998. At the end of that tour in 1999, I was seconded across to Bank Bali, and I had the experience of actually being physically swept from the office, which was in Bintaro. So a different kind of financial sector experience, but one that was memorable nonetheless. And then all through this period of 1987 through to 2010 and beyond, with major global banks to 2015, 4 major global banks, Standard Chartered, American Express, Bank of Boston, and Bank of America, all with Indonesia coverage responsibilities. And then from 2016, I've been covering Indonesia with training and advisory services, and most recently with the London IBF. So Indonesia is the place that I've got a great deal of personal experience, and I'd like to share with you some of the insights gleaned along the way. But first, I'll give you an outline of what I'm going to cover in the first 30 minutes or so. I'm going to be talking about what is governance, risk, and compliance. What does it look like? What's the practical way of implementing it if you're a financial institution in Indonesia and elsewhere? And in the final session after the panel, we'll be talking about the role of the regulators. And the key messages are that GRC is absolutely a prerequisite for raising and maintaining financial sector performance. You can't do it without GRC. It's a bit of a burning platform. Incumbent banks, and particularly non-banks, need to improve their GRC capabilities. And I'll go into that at length. And regulators and supervisors have played such a key role in helping to shape the way in which GRC develops in any particular country. So section 1 is going to be the introduction to GRC. Section 2, implications for FIs. Section 3, implications for regulators and supervisors. So let's go into the first section. Now, what are the sort of risks we're talking about? And they're on the left of this screen. The first task is to identify what are the risks your institution is facing, the financial risks and the non-financial risks. And I've listed them here. Now, the main ones, particularly that the banks are concerned with: liquidity and funding, capital leverage and credit risk, market risk, which is the price risk from interest rates, foreign exchange, and commodities. But there are also, of course, many others: reputational, cybercrime, legal compliance, operational, technology risk, KYC, AML. But this is the universe of risks. You can't manage these risks without a structure. We call that structure a risk management framework. What does it look like? You go into an institution, you will know immediately if they have a risk management framework or not. And we go to the right-hand side to see what are the components. First of all, is there a strong risk culture and risk governance? And that comes from the top. It comes from the NEDs, the non-executive directors, the board, and the executive directors and the executives of the organization. They have to have risk a top-of-mind issue. Otherwise, you will not have a risk culture in an organization. It has to start at the top. The roles and responsibilities, risk management is everyone's responsibility. And there are 3 lines of defense, which I'll be going into. There are very clear processes and tools, definition of risk appetite, tools for measuring risk, active monitoring, limits. And there are various internal controls which are built around the framework, systems and infrastructure too. So you'll go into an institution, you'll know very quickly, have they got a strong risk management framework or not? The 3 lines of defense, what do I mean? Well, the first line of defense manages the risk. They are typically originators. They might be people in a bank, for instance, who are making a loan, or in a trading room doing a foreign exchange deal, or doing a money market deal. They are the originators of risk. That's the first line of defense. They need to have a strong risk culture strong discipline around the level of risk and the type of risk that they can take. The second line of defense is the independent specialists in risk management. They set the risk guidelines. That might be market risk department. It might be a credit risk department, but they are specialists. The third line of defense is independent audit. Independent audit. So when we're thinking about risk management framework, it's not that manager sitting in a windowless room who's responsible for all the risks in the organization. It's the entire enterprise. It's a framework with 3 lines of defense. I've given an example here for liquidity and funding from banks. The first line of defense might be treasurer or traders with the ALM, the asset liability and capital management, also as part of that first line. There might be then the independent specialists in the liquidity risk assurance. And finally, there'll be the independent audit. That would be a typical example of 3 lines of defense for liquidity and funding. There will be 3 lines of defense for each of the risks: credit and capital and leverage, for market risk, for liquidity and funding. There always will be the 3 lines of defense, minimum 3 lines. What is a risk appetite statement, and what's its purpose? Well, it describes the type and quantum of risk a firm is willing to accept to achieve their strategy and goals. It's a document. It's approved by the board of directors, and it informs the strategy and the process. Now, why is that important? Because if you don't quantify the risk that you're willing to take, it's very, very difficult to manage it effectively. So you need to quantify it and to decide what is your appetite for each type of risk, for capital adequacy, for liquidity and funding, etc., etc. The process is you identify the risks, you select the key ones. They're the ones that will have a risk appetite statement. They're the ones that will be informed and aligned with a strategic plan. And you set the boundaries and manage and monitor them. What else do you consider? Well, you consider stress tests. Stress tests are where you simulate stress in the external environment. What effect does that have on the risk you're managing? How badly does it affect things? How will you mitigate the risks? There'll be independent regulatory returns, the ICAP, the individual capital adequacy assessment, or the individual liquidity adequacy assessment. And there'll be top emerging risks where you're doing a sort of radar scan. What are the risks coming down the pipe? These are the processes by which you develop a risk appetite statement. The framework comes out with then 3 measures, and I'll just give you an example. The risk appetite is how much and the type of risk you're willing to take to achieve objectives. But it's like a precision engineering. Precision engineering, you always have an acceptable tolerance level. So the board also defines what is the acceptable tolerance they're willing to accept around that appetite. I'll give you an example in a minute. And the risk capacity is how much you would be allowed to take by regulations. So go to the right-hand side. Let's look at liquidity in banks, for instance. You have a regulatory ratio called the liquidity coverage ratio. The minimum it can go to, the floor is 100%. Now, a bank may say, we're going to set our appetite at 120% or a level above 100%. And we're going to accept or set our tolerance at 110. What that means is it should never go below 110%. Never below 110%. It might go between 120 and 110, but never below 110. And that's still a buffer over the liquidity coverage minimum requirement itself, which is 100%. So that's a typical example of how a board will define its risk appetite for liquidity and the measures it will set around it. And it does the same thing for all of the key risks. Stress tests are very, very important. Whether you're a bank, whether you're a non-bank financial institution, it's a formal, quantified process of determining what would be the impact on your key ratios if different severe adverse events or scenarios took place. You might be looking at capital adequacy. You might be looking at liquidity and funding. You might be looking at a number of different aspects. But you need to have a quantitative way of assessing that risk dynamically in different scenarios. Now, there are different types of stress tests. There are regulatory stress tests, which are typically the same for every institution in a sector, i.e. for the banks, this will be the stress test they must run. But banks should also be running their own stress tests because they know better than anyone else what they are more vulnerable to in terms of risks. So stress testing is an integral part, internal stress tests and regulatory stress tests, in identifying and understanding risks and how you mitigate them. They're getting more complex, they're getting more frequent, and they require quite a considerable investment in terms of resourcing and time, but it's absolutely critical to delivering resilient GRC. There are lots of limits around each of these types of risks. I'm not going to go into huge detail on these. They're listed out. For liquidity, you have regulatory limits. I mentioned the LCR, the non-stable funding ratio, various other limits. There will also be internal. It's a question of picking up what are the regulatory limits for each risk and adding and supplementing those with internal limits. Contingency funding plans or contingency capital plans are also extremely important because they detail what action you take when you enter into a stress. I've been through numerous stress occasions, and there is no time when stress hits you to write a contingency plan. There's no time. You're dealing with the stress. So it needs to be the go-to plan so that when the stress hits, this is the playbook. This is what everyone knows what to do. They've rehearsed it before, and it's documented, it's updated, it's reviewed in the appropriate risk committees, ready to be implemented. Now, practical implementation. Let's say you're a financial institution and you're thinking about, well, okay, I get it. I understand the importance of GRC. How should I actually implement it? What should I do? Well, the first thing is to identify which are the critical risks impacting your institution. And you can go through this list that I put here, or these bubbles, and determine it from this, or we can add, there could be other risks beyond the ones that I've listed. But the key definitions are which ones would result in regulatory breaches with potential loss of license. That puts you out of the game. You're not in business anymore if that happens. Which would contravene laws and result in catastrophic penalties. That puts you out of the game. What is material to the firm's financial performance and strategies? Materiality is important. What would seriously disrupt your business? And finally, what would damage your reputation? So you prioritize those risks in your GRC framework, the risk management framework, that are the priorities just expressed there. Now on the left, on the right. So what's lower priority? Well, if it's not relevant to your business, or it's immaterial, it's too small, or it's effectively mitigated by insurance or other remedies, or there's a very low probability of occurrence, or if it did occur, it would not be devastating in its impact. So you can't develop a GRC for everything, everywhere. It will take too long. You will not be sufficiently focused. The key is to prioritize. Now, what are the benefits? We've talked about, yes, it's necessary, why it's necessary, how you can do it. Well, the benefits are very pragmatic and clear. It reduces surprises or chances of what's called in some places a banana skin reputation. That means you slip up, you step on a banana skin and you fall over. There are several examples around the world of financial institutions that have garnered banana skin reputations over the years. And it's very hard to shake that off. So the benefits are you reduce the risk of that. You position for growth. If you haven't got strong, resilient GRC, you're not positioned for growth. You stand out positively versus competition. You can improve financial performance because you understand the risks better. And you can improve the valuation because your earnings become more stable. So there are financial reasons to have a strong GRC. Now, in the middle, I've got an example of JP Morgan. They are the biggest bank in the world. Their balance sheet is 3.7 trillion US dollars. And they have what Jamie Dimon, the CEO, describes as a fortress balance sheet. He's called it that for at least the last 10 years. And it comprises all of the elements that are in the center here. And JP Morgan really, really works on GRC continuously, dynamically, in a very focused manner, which you have to do if you are a global universal bank of that size. Now, what are the trends taking place? Well, more and more focus on standardized capital adequacy rather than internal ratings based, because it's becoming a more binding constraint. More use of simulation tools to understand the impact of different scenarios. Dynamic allocation of balance sheet resources. People use this word resource. Capital is a resource. Liquidity is a resource. Leverage exposure is a resource. These are, some people call them constraints, but in the banks that are strong on GRC, they call them resources, and they manage them as scarce resources. If you're good at GRC, it also allows you to be expert at balance sheet optimization. Balance sheet optimization is defined as complying with all internal and external requirements and maximizing performance, returns, revenues at the same time. That's balance sheet optimization. I'm going to give you some live examples of risks and in a way, GRC disasters that are happening in the world just in the last 6 months. FTX, which you know in terms of the crypto exchange and FTT cryptocurrency, the comment of the liquidator, never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurs here. That's a complete governance failure. And I've put the failings in terms of the risks from the bubbles from the previous charts. Liquidity and funding failure, market risk failure, capital leverage and credit risk failure, reputational failure, legal compliance and conduct failure, all failures. So it was an across the board failure of governance, and it wiped out $40 billion of value almost instantaneously. That is the stark demonstration of what happens when you get GRC wrong. What else? This is an interesting one, which is in Japan. And remember, in Japan, they've had 20 years of zero or negative interest rates. And that prompted a search for yield. That means banks try to invest as long as possible in government securities. In JGBs, Japanese government bonds, you have 50-year tenor. In Australia, you have Austria, not Australia, you have 100-year tenor, century bonds. But when you have a lot of banks investing in very long tenor securities, if interest rates go up significantly, it can cause significant pain in bank balance sheets in terms of mark to market, in terms of capital. So there is a big strain, and in fact, a little bit of a battle going on to try, BOJ, to try and contain the rise in the rates in that yield curve, which is an interest trend. So you've got problems there of more about market risk in the middle, which is the market risk of the government security portfolios in the banks, because they're so long dated. You've also got liquidity and funding risks, because often they can be used for collateral requirements as well. This one is another example, and you'll see in this one, it's a non-bank financial institution. And in the UK, we had big problems with the pension funds, which arose when gilts, which is UK bonds, rose rapidly by about 3% in a very short period of time. That exposed problems in UK pension funds that had invested heavily in something called liability-driven investments. Now, the problem with these LDIs, they had significant leverage, and it didn't become clear how much that leverage was until this big increase in rates happened. And that then spilled over into liquidity and funding issues, which caused some major trauma quite recently in UK financial markets. So it was search of yield, an area of low rates, investing in areas which had high leverage and not sufficient understanding of the consequences of big rate changes. And banana skins, well, you can have a bank which got great ratios, very secure, but if there are surprises that keep on popping up, i.e. a big credit loss, a compliance fine, a conduct issue, and it's the same bank and it's happening every 6 months, in the end, the market gets skeptical, and in the end, they actually give up. And your CDS, a credit default swap, spikes, even though your balance sheet measures might be looking quite prudent and well managed. Now, the fact you've got prudent, well managed balance sheet means you will survive, but you need to avoid a banana skin reputation if you want to have maintain lowish funding costs and a good external rating. So that's all I'm covering in that first section. I'm now going to give 5 minutes simply to kind of lead us up to the panel session, talking about the implications for FIs. But I think one of the key takeaways I'd like you to have from that session is that the risks that are really becoming stronger now are actually the risks affecting the non-bank financial institutions. The reason that's true is because the bank regulations have evolved and become very strong post-global financial crisis, with Basel III and various other excellent work by regulators around the world. The bank sector has been brought into a situation where capital levels are much higher and governance and control is much stronger. The area that is rapidly expanding is non-bank financial institutions. And they don't have quite the same experience in managing through some of these stress periods. And they have less in the way of the really deep regulatory coverage around the world as compared to the bank sector. So I'd like to, and the reason I gave some examples of governance problems which are outside the banks is we're seeing increasing frequency of non-bank financial institutions being where the problems reside. Now, this is a list. I'm not going to go through it in detail. You've already seen the bubbles with all the risks, but I've given more specific examples of how those risks manifest in a particular financial institution. And the commonality of them all is the uncertainty that arises from these risks. Uncertainty which gives rise to negative financial or non-financial outcomes, insufficient cash, inability to repay, non-repayment of loans, etc., etc., etc. I'm getting a reminder on my personal alarm that I've only got 2 slides left, which will be no problem. Then we get to panel.
Yeah, you have 5 minutes left before the panel session.
Excellent. I'm exactly on that time. Thank you. So what are the different types of risks? Well, there are country risks. Now, if we look at close by, neighbors close by, have we had really, really extreme country risks? Yes. If you look at Myanmar, the country risk in ASEAN country, Myanmar, was so extreme, it resulted in a minus 18% GDP, much, much deeper. This was in 2021, much, much deeper than any of the countries in ASEAN. And the recovery, of course, has been less strong because of the situation in Myanmar from 2021 onwards. Sri Lanka, different types of problems, but look at how they caused such a collapse in the GDP during 2022, the year just passed, and continue through into 2023. So we've got governance, risk, compliance issues which have faced huge stress in those two countries. They've gone through the most extreme stress test imaginable. So this is real. It can happen nearby, and we need to be ready for all circumstances. It's not just a desktop exercise. There are also then sector-specific risks. China, there's been huge focus on the housing market in China in terms of it's been quite heavily leveraged. To what extent is it going to have a soft landing? A big focus on that and the implications on how that ripples through the rest of the economy. That's just an example. And of course, in individual institutions, if the CDS spread, the credit default spread, blows out like this one, it's probably a sign that you've got a name-specific issue taking place. So we've got these three types of risks: country, sector, and institutional. I've got several examples here: liquidity funding gaps, and there have been all kinds of crises. US savings and loans crisis was an interest rate mismatch problem that went into a liquidity risk. Global financial crisis was a liquidity and funding problem. Asia financial risk was crisis was an FX mismatch problem. And the non-bank financial institution crises seem to be what's happening in the 2020s. So every 10 years or so, we get major crises washing through. And my final slide on this section is that risk evolves. GRC evolves as a company grows in complexity and size, and its different stages on the journey. When a company's just coming into being, like a new digital bank, its risk starts with capital raising. Then once it's got the capital, it's probably investing that capital in marketable securities to start off with. It has market risk, has some funding risk, has some liquidity risk. But then when the customers start onboarding, there are different risks. You've got the tech and ops. You've got know your customer and AML. You've got legal. You've got conduct and compliance. And as the business grows, again, it's tech ops, it's cybercrime, it's reputational. And then once you've got a very decent sized balance sheet, you've got all of the credit risk, liquidity and funding, you've got the market risk. So the risks are dynamic and constantly evolving depending on the complexity and size of the institution and where they are in their journey. And that's it. I hope I'm on time there. Aldi, please reboot me if I'm not.
Yeah, you are on time, Mr. Nick. Maybe you may take 5 minutes break before the panel session. Thank you very much, Mr. Nicholas Wood, for your inspiring presentation. It's also insightful. And ladies and gentlemen, to summarize the presentation of Mr. Nicholas Wood about the GRC development. So the presentation concludes by 3-section introductions of GRC and then implication for financial institutions, also the implication for regulators, and 2, implement risk management framework. There will be 3 lines of defense that need to be managed and applied. First, manage the risk. Second, set risk of guidelines, and independent audit. That will be 3 layers of, or 3 lines of defense that could be used to, develop the risk appetite statement. And risk appetite statement that can be used for financial institution to quantify each line of risk to effectively make the risk appetite framework that consists of triangle of risk appetite framework, first risk tolerance, risk appetite, and risk capacity. And Mr. Nicholas also emphasized about stress testing that could be implemented by bank or non-bank institutions that could be part of integral part to understanding risk and how to mitigate, and as a result, the resilience of GRC. So, ladies and gentlemen, there are area of GRC that Mr. Nicholas Wood presented, and it need to be prioritized by bank or non-bank institutions to maximizing performance and also get the more profits. And from the presentations, I also have some points that need to be answered maybe during these panel discussions. First, about what are the mistakes that oftenly happen on financial institutions in implementing risk appetite statement, and also followed by risk appetite framework. And the second question from me is, what is the best practice of implementing GRC that you, the speakers and panelists, have already researched in Indonesia and also in Asia? And also, Mr. Nicholas would mention about non-bank financial institutions poses the higher risk, so it needs to complete the GRC framework completely to finally can maximize the performance and also profits. And I believe that my questions will be answered on the panel discussions. Ladies and gentlemen, once again, I would like to remind you that you may type your question via Q&A section. Please put your name followed by institutions and also the speaker that you address your questions to, and your question will be answered after the panel discussions. So, Mr. Nicholas Wood will also lead the panel discussions today. And I would like to invite the panel speakers for today's event, Mr. Lim Eng Ai, Chief Executive Officer of Tech Create Solutions, and also Mr. Lim Eng Ai, Tech Create. I would like once again welcome Mr. Nicholas Wood to lead the panel discussions today. Mr.
Thank you very much, Pak Aldi. Panelists, welcome again to Heng Ai and Ahmad. I think we'll start with Heng Ai and go straight into Heng Ai on the payments. How is the payments landscape changing in ASEAN and Indonesia? And if you could start, from ASEAN first and really the big picture, and then move into Indonesia from there.
Yep, sure. Thanks. Can you hear me? Just.
Yes.
Okay. Yeah. Thanks for the invitations. As what you have shared, I think we are going through a very interesting time in payments. We were honored to be one of the Indigo members that implemented the Singapore fast payment system in March 17, 2014. We have seen a lot of movements or much more implementation within the regions on real-time domestic payments. We were also lucky to actually seize the starting of cross-border payments within ASEAN country, bilateral at least now. I think one of the key milestones of all this movement is really back in 2015, after Singapore had launched it, the ASEAN financial ministers has all collectively agreed to use the common standard ISO 222, which Ahmad and myself has been actively participating in and the recent development will be the signing of MOU within ASEAN between Indonesia, Malaysia, Philippines, Singapore, and Thailand for a regional payment connectivity, which called RPC in short. I think that's where we are going to see a lot of the ASEAN's interconnectivity is going to be happening. At least within ASEAN, I think we have around 7 countries that have what we call an instant payment system. And I think within the general landscape, the general settlements and the general use case is actually adopting of a QR code-based payment system. That is, and also using a proxy, be it a mobile number, a company registration as a proxy to your bank account numbers, noting the emphasis on customer privacy. It's getting more and more interesting, and we are also seeing a lot of global adoption on this. Just November last year, we saw EPC, the European Payment Council, raise international standards, global ballots, to actually adopt an EPC-based QR code payment specifications on top of the or deviating away from some of the ASEAN's initiative, which we have been working very closely with the ASEAN Banker Associations, which we are pushing for the EMB code QR codes. And I think FastBI is also on the same standards. There was a huge collaboration or a short battle outburst within the global community on the movement. Primarily, we were very clear that ASEAN is on track for standardized interoperability structures for payments, whereas the Europeans is trying to adopt different standards. I think with the assistance of PBOC, the People's Banks of China, and the consideration was simple, that if you look at QR code payment globally, the first adopter or the biggest adopter of QR code payment would have been the Chinese community. They started it with their WeChat Pay, their Alipay. So these are the general payment landscape that we are seeing. And I think it is going on the right track, but there's also some fundamental considerations, and we were very lucky that during the Singapore implementation, one of the key branch or key considerations for real-time domestic payment infrastructure is actually setting up a risk and liquidity management working committee to look at what is the fundamentals to make sure that your domestic payment infrastructure has the resiliencies to meet up with some of these ASEAN connectivity requirements. I'll elaborate a bit more on this subsequently. I think in terms of Indonesia, Indonesia FastBI was launched on 21st December 2021, almost in the second year of implementation. Fantastic performance based on our understandings, more than 100 participants, and you're extending it to non-financial institution or payment service provider subsequently. We are also glad to see there's a lot of initiative that has been launched by Indonesia to look at cross-border connectivity with Thailand, Singapore. All these are in the press. And I think there's also talks about Timor-Leste connecting to noting the proximities and the historical considerations. So we are very happy and things that definitely the whole ASEAN is moving towards the right track of interconnectivities. Going back to the considerations, the impacts of this, and going back to the agenda for today's presentation on governance and risk compliance. One of the, and we were fortunate to also look at this same consideration with one of the ASEAN country recently. We were in one of the ASEAN country. They are one of the 3 countries that has not implemented an instant payment system. In that session, we were asking, in the situations whereby there's a liquidity crunch and the financial institutes is unable to meet their settlement obligations, what will be the system handling? Will you all be able to manage such an outage, and the answers from the technical solution vendor is it will never happen. Okay, that was something that makes us fall off the chairs. And basically, I take a look at the CEO as it. So in terms of risk management framework, you're going to fill your very first requirement with the principle of financial market infrastructure. And I say we must all understand that, that there's so much governance on market infrastructure nowadays. Primarily, we do not look at market infrastructure like a payment, instant payment system as an IT system that's running. Is the lifeblood of a nation. Is how you move funds from account to account. In some country, the country governance will actually say that this is a utility. Without this, something will stop. If there's something that happens to this, within 5 minutes, the social media will be flooded with feedbacks, comments. I mean, there's such a big impact, and the whole digital evolution that we're looking at. The way we were looking at it in all our consulting job is that you can do digitalizations, you can create digital benefits, but if you are not able to transfer the financial benefits, you know what I mean, your digital economy is not going to be sustainable. It's one of the integral part of a nation's infrastructures. So it's very important to have that risk and considerations. The typical considerations is always the big words of, is there a systemic risk? It's getting more and more complex, primarily because the non-FI is coming in. A lot of these real-time payment infrastructures, the fundamental is that the clearing occurs prior to the settlements. Whereas if I transfer money to Amok, my bank's deducted money from me, Amok's bank pay on my bank's behalf to Amok's, but the bank have not settled their positions. And this is where the counterparty risk, whereby if the banks default, who will cover this risk? Okay, and if this risk is substantially big, or one of the more established or one bigger market player is causing this risk, or there's a run of money due to a lack of trust in the systems, then it can effectively down the whole financial systems. So the ability to build that liquidity management, the counterparty risk management, and not to forget, once you bring in PSP, and because the nature of such settlements is typically done on the RTGS system, which traditionally is a high-value payment systems that is operated by the central banks. They will not be a member of that systems, and a lot of the PSP has to leverage on the banks' ability to settle their positions. This would actually deeply affect some of the banks that's offering this as corporate financial or cash management services or custodian services. So that's a huge prospect of it. Why I'm spending so much time on this and sharing big thoughts on this. When we were looking at the Pay Now and PromptPay implementation 2 years back, this become a very integral point whereby if you look at ASEAN's, all 10 countries all have their legal system, all have different languages, risk appetite, country risk. Is no longer a typical word of trust, but really what is that risk framework that you have to protect some of these? Do you have the equivalent of a financial and netting act, whereby if a bank defaults, clearly identify how would some of the collateral be used to manage all these settlement risks? This is going to be integral, and if the ASEAN country is going to interconnect more, this is going to eventually even affects the use cases. Primarily, if you do not have a strong collateral management system, liquidity management framework, it will affect the transaction limits that is going to be come through that in the ASEAN link, and linking together you will see enough reference in established European countries like ECBs. If one of the European banks is being affected, or one of the European countries is being affected, they will become the weakest link and effectively affect the whole ASEAN. And definitely the countries may want to look at how they can protect themselves and manage that risk, because it's going to be a huge challenge. You look at Europe's have Germany as a big economy, and basically the Deutsche Mark has been the fundamental of euros. There's no equivalent ASEAN currency, or who is going, and most of the ASEAN transaction is still based on greenbacks, so or based on US dollar. So those are the underlying fundamental. As the ASEAN countries starts to progress, if we want to improve that capability of interconnectivity in ASEAN, that fundamental framework of risk management needs to be carefully thought through. And the last point that I may say is that really what is that governance frameworks within ASEAN? There's really a few initiatives that has been moving on. The RPC as one, PIS Innovation Hubs of Singapore has been looking at mixers, but who is going to be the governance body to make some of all these governance frameworks is going to be one of the integral parts to make these payments evolutions interesting and relevant. Yeah.
Thanks, Shanghai. Let's go to Ahmad. Let's change from payments now to insurance, Ahmad. What's your kind of view on the landscape in ASEAN and Indonesia, how it's changing?
Hey, thanks, Nick. Thanks all for giving me this wonderful opportunity to share some of my thoughts on the insurtech as well as what's happening on non-banking FI side in ASEAN and Asia. Nick, first of all, amazing presentation from you about JRC, what are the risks, and also I will try to keep my answer related to that only, so that it will be focusing some of the points or the questions that you have raised when you were making the presentation. So if you look at the insurance landscape, it's constantly evolving with the changes driven by various factors such as advances in technology, shift of consumer behavior, regulatory developments, and so on. So if you look at what's happening on the insurance side is that the winds are moving from west to east, because what we have seen in the banking world, the same thing is happening on the non-banking side, where the most of the development changes first happens in the West, and then slowly it gets adopted in the other countries and all. So we see the same thing coming from west to east. And if you look at in the more on the ASEAN perspective, the countries are in the different stages of their evolution. One side of spectrum, you have a open pricing country like a Singapore, and the other end of the spectrum, you have highly regularized market for insurance, which is a Vietnam. So while the landscape is still changing, it's an evolving stage at this time, but there are some of the key themes which I think why this is helping to change the insurance landscape in ASEAN. The important thing is the digital transformation. The insurance industry is rapidly moving towards the digitization. The adoption of new technologies such as artificial intelligence, machine learning, data analytics are being used to improve the efficiency and the customer experience. So that's a big change that we see. The second one is like what we have seen on the banking side or the financial services side, which is a fintech developments and all. We see the similar thing on the insurtech side when it comes to insurance. So insurtech is nothing but using the technology to evolve the insurance industry. So why people are doing this type of thing is because if you look at the most of the insurance companies and all in the region, they are using the old technologies. They have never basically improved some of their technologies and all, and it requires a significant investment going into it. And that's the reason this type of insurtech companies are coming and helping insurance companies to grow faster at this time period. So what the insurtech startup are doing is basically they are disturbing the traditional insurance industry by offering innovative products and services, often focusing on the digital channels and the customer-centric experience. So what they are doing is that they are using a new technologies such as AI, blockchain, telematics to offer more affordable, transparent, and flexible insurance product. Because every time when we see a premium, we don't know how that calculation has been happened. And we always ask this question saying that why I am paying so much for my, for example, motor insurance policy. I am a good driver. Why I'm paying so much for my policy? So I would just highlight that we are the first one in Asia, in Singapore, to launch Asia's first green insurance, which is promoting safety and sustainability in Singapore. So that's how we see the changes are happening. The third one is that very important thing, which is the climate change. Because if you look at the climate change, insurance are adapting their offering to reflect the growing risk coming through the climate change, which is because of the extreme weather events, natural disaster, or climate-related risk. So if you look at overall, they are basically managing this risk and trying to evolve the offering around that so that they can serve the consumers or the customers much better than what they are doing today. Nick, over to you.
Thanks, Samod. Let's go back to Heng Hai. And I want to build on Pat Aldi's question, which is, what are the mistakes in implementing GRC and risk management framework? And Heng Hai, very specifically with financial institutions, where you've got anti-money laundering, you've got sanctions, you've got a bunch of complex challenges facing the FI's sector. So how are they, what mistakes are they making, and how are they implementing more robust GRC in payments?
In payments. Yeah, I think in payments, the general, especially for FIs, I think the biggest challenge the banks had was really on the point of sanction screening, the AML checks. It's really getting very tough with the expectation that the payments need to be 24/7. You need to avail the funds within the windows of less than a minute. In fact, 15 to 20 seconds, the fund must be in. And the general settlements and the general approach is typically that you can defer it. And there's a lot of countries that is operating on a model whereby for local currency, local account to accounts, online sanction screening is deferred and post-sanction screening is being done. And the challenge with that is really when you start to move beyond your own domestic markets. When we were doing from pay to pay now with the Association of Bank in Singapore, you need to do that online sanction screening, noting that these are across two infrastructures. It's important for the FIs to start to look at this. And we are seeing global banks that had put in place capability to manage this risk well, having an edge compared with other banks. In fact, like what Ibu Sufia was talking about, we were in the discussions with some of the banks that how do we use some of the global solution or new technology or technology disruptor like what Amok was alluding to in terms of AI. And you'll be surprised. The challenge now with AI is even to help with the field of sanction checks is really, is your AI trustworthy? At the end of the day, you are going to put in data, and are those genuine data? We are even hearing feedback and complaints that, data has been used to influence elections here. If you recall the U.S. previous elections, and globally things is starting. Everybody understand the impact. It's like ChatGPT is here to stay. The technology is coming and it's going to be a major disruptor. If you look at even the recent report, who had the biggest fall off their chair is the CEO of Google. It was a code red for them that GPL would change the way we use our search engine. All this technology disruptor will, and financial institute needs to understand this. But there must be a risk management framework. And the most interesting framework that we are seeing in the market is really on this point about trustworthiness of AI. And actually, the ISO IEC committee under JTC1 has actually come up with a technical reference. The technical reference number is 24028. Sorry, it's a bit mouthful. It's a series of numbers. I repeat, 24028. It's really about coming up with the approach on how to establish to trust the AI system through transparency, explainable accountability. Some of the engineering pitfalls and typical associated threats and risks of AI system, along with possible mitigation technology and methods. I think these are very important. And also approach to actually access and achieve the ability, resiliency, reliability, all the keywords. And one more important one that I picked up even by earlier on is on security and privacy of this AI system. I think this is going to be a general trend, and if the OJK or the FIs in these events, if you want to look at it, I think this will be something that they can actually seriously think about and look at. It's really going to be an age, and the world is just getting smaller. Most of the ASEANs or even more the banks are moving beyond their domestic infrastructures. And the primary reason is also we are seeing trends that FI is no longer looking at threats from FI. They are looking at threats for fintech disruptors like Wise, that Revoluts, that is disturbing their revenues. So I think this is something that they can really consider.
Thanks, Henghai. That's my takeaway from that is that domestic payments, where in payments everyone wants to have speed and accuracy. They want to have that's the key. Domestic payments, they're managing to get there, but it's much more complex once you go cross-border. And my takeaway from your comments is that because things are evolving so fast on cross-border technology, cross-border approaches, that's where mistakes could happen. That's where we could have things going wrong in terms of anti-money laundering sanctions, screening, cross-border. And we've seen it time and time again. When a new technology or a new breakthrough comes through in making something much more convenient, much more accessible, it also opens up new risks. And that's what you've just described for us, I think, on cross-border payments. Thank you, Henghai. Amol, to you, same question, building again on all these question here. What are the mistakes, if you look around and you've seen a lot in the insurance area, in implementing GRC, there might be a noble aim, a noble objective, but what goes wrong and how can it be improved?
Difficult for me to judge and say that these are the mistakes and all. So I will change the question and can only talk about the challenges which are faced by the insurers in that side. So if you look at the governance, risk management, and the compliance are the critical areas for insurers. And as the industry evolves, the new challenges and emerging that the insurance must address these things. And as I mentioned, I don't want to call it as a mistakes, but these are some of the challenges which are being faced by the insurers in Indonesia as well as in the region. So first and foremost is the cyber security. We all talk about digitization and all this. So there is insurers are increasingly becoming digitized, and they are exposed to growing cyber security risks such as data breaches, hacking, etc. So what they need is robust cybersecurity measures and ensure the compliance with the data protection regulations within the country to manage that. So that's point number one. Point number two, what we see on the insurance side is more of a operational risk issues. Because there are basically insurers face a range of operational risks, such as fraud, errors, omission, compliance breaches, and all. How they can use the technology and implement the controls very effectively to manage the risk and minimize the impacts on the business. That's another challenge, what I see. The third one is third-party risk management. When we say third-party risk management, is also managing the risk with third-party administrators. So most of the insurance companies today, they use third-party administrators, and they completely rely on them managing the workflow, they managing, for example, the claims. In like Indonesia, most of the insurance companies has outsourced their claims to third-party administrators. So they don't look at what is going in, what is going out. Are there any frauds happening? How the TPAs are managing this? So those type of things, there are needs to be a different type of approach to manage that. As I have mentioned, using some of the technology like AI, machine learning, they can manage those risks, they can manage those frauds differently. So I think, and the last one is a compliance with the regulatory changes. Because in Asia, as we see, most of the, we are basically catching up with what's happening in West world. So most of the regulators and all, the day when they see some of these challenges are happening, some of the frauds are happening, they want to come up with the new regulation, new compliance requirements and all, and how insurance companies can manage them effectively and all. That's an interesting thing. Not in Indonesia, but I would like to give an example of a different country where the insurance company, they mentioned to me that they give credit to some of the car dealers and agents of 6 months. So which means they don't get the premium on the same day. And those guys, they use that money in the market to invest. And the regulators in that country is okay with that type of approach and all. But again, who is at risk? If something goes wrong with the policy holder, how you can handle that, how you can manage that. There are so many ghost policies which are there, fake accidents getting reported. So those are the type of issues which are there. And I think the GRC, good GRC framework will definitely help to reduce those things. That's what I think.
Thanks, Ahmad. Now we've got about 2.5 minutes each for you to answer the last question. And this is really around the implications for regulators. You know, we've got these rapid developments and innovations. We've got risks, which are new risks which are emerging as innovation is implemented. What would be sort of your guidance in terms of, you know, what are the priorities in terms of of supplementing what regulators are already doing in this space? Heng Hai, you first on payments.
I think the typical challenge that we are seeing in the regions is really awareness and really bringing some of the global practices to the ASEAN community. Ahmad will echo the same view that I have. Currently, even within the ISO movement, we only got 2 ASEAN countries that's representing the whole ASEAN, which is Singapore and Thailand. So I think it's important, and I think those exposure awareness will actually help us formulate better governance frameworks and learn from the global communities, and build that awareness.
Thank you, Heng Hai. Ahmad?
See, if you look at the insurers face a wide range of GRC challenges in a fast evolving insurance landscape. So the regulators and insurance remain vigilant and proactive in identifying and managing this risk to protect their operations and meet the evolving expectations of the customers. So that will help both on that side, because difficult to finger point one point over here, because all the regulators are doing a fabulous job in managing those risks, keeping tab on what's happening in the country and all. So what I would say is that because of the changes in the technology, the Data Privacy Act coming in and all this, right? It's basically based on every insurance company's priorities, how they want to manage that. I think it will go with that, rather than, because regulators have come up with the list of things that they need to do, they need to perform in each country and all. So difficult to say that, but again, I would say it's more for the insurers to manage these things differently is the most important.
Okay, we've got a couple of minutes, and I've got a question on disintermediation. Heng Hai, you talked about new players coming in, and I've used them myself, to be honest, in terms of transferring funds, because they do it very efficiently and at low cost. But in terms of risk, you know, it used to be that these things were all handled in a bank or a specialist money transfer operator. But now it's getting, these services are coming through with a bunch of fintech operators, let's say, payment specialists, standalone non-banks. Any thoughts on terms of just that trend? What new risks is that bringing to the table?
Actually, we were talking about it within a few of the payment practitioners recently in the industry discussion. A lot of this fintech company really lack the governance framework banks has and the exposures. Today, the banks are charging certain price because of the potential risk, and really, if you look at it, if it's profitable, if it makes sense, the banks will have come in. If there's the fintech company is taking additional risk, the user themselves will have to put in some of their own risk considerations when they use that services. An example would be, for example, all these third-party providers, they may give you a better rates, they may be less stringent in terms of KYC requirements, but you do not want to put too much funds with them. You use them on the demand basis, so that in a situation whereby they really default, then your risk exposure is being managed. We are seeing even very innovative. Now they even offer business corporate accounts whereby they offer some of the potential treasury functions down to normal skills. But if you ask them, how do you hedge your forex risk? And that was the determinants that brought down Sri Lanka's. They run out of US dollars to put some of the bills. So they don't have a good risk management portfolios. And going back to one of the questions that was raised in the Q&A is how do Singaporeans actually manage some of this? It's really, there was an act of a Payment Service Act based on the payment service activity itself. There's a payment service supervisory team under MAS that will actually look at those potential risks and how we actually mitigate them.
Thank you, Heng Hai, and thank you, Ahmad, as well. I think we're about out of time. I'm going to hand back to Pat Aldi now, but thank you both very much. And please stick around for the Q&A, because I'm sure you're going to have
actually, we still have 10 minutes to conclude our panel discussion.
We have more time?
But I think the question from Mr. Wood about the technology, I intrigued to know how the technology nowadays we know that many companies implement artificial intelligence to create the system. And Mr. Heng Hai, how do you think about the artificial intelligence using to, what are the advantage of using the AI and also the disadvantage compared to using the conventional GRC system that Mr. Nick earlier elaborated?
I don't think there's any contradictions between a risk, a governance risk compliance framework and the using of AI. And actually, with the use of AI, the primary concern is the trustworthiness of that AI solutions. We have been in the field whereby the banks, if you look at it, especially the Chinese banks, they have been using what we call facial recognitions. And if you talk to some of the professors in the schools who is specializing on facial recognition, they say if you train the AI to recognize a human, but you started to feed them data to say that this is a cat, the AI will tell you that this is a cat. Okay, and the GRCs that is required is really like what I mentioned earlier on the technical reference, that there needs to be a way to manage some of these technology risks and closely look at how you can do it. We are seeing regulators coming out with a 5-tier implementations of some of these risks, which they will always say is that what is the potential usage of the AI technology? Are you using this data for reference? Are you using this data for recommendations? You to do some prioritizations to help to optimize the work, scoring, or even doing adaptive, which is the most advanced stage of it. And I think the usage will define the risk and what type of controls you need to put in place. If you want to use scorings, you want to use the risk is going to be higher than if it's just a recommendations. I recommend that you approve this loan rather than based on scoring, I automatically approve the loans using AI technologies. So those are some of the considerations that the bank should consider when they look at the usage of AIs.
If I may add to few things on the insurance side on AI, because that this particular topic is close to my heart also. We have implemented AI on the two things for insurance companies. One is when they buy the policy, we request the policyholder to take photos and send it to insurance company. And we use AI to tell them what are the pre-damages before they buy the policy. So instead of you sending a particular individual over there to check the vehicle and then issue the policy, this is being done directly with the AI engine and all. That's one. The second thing is with AI, help of AI, we can tell whether this is a fake accident or not. So we have around 11 algorithms within our application to tell, and this is AI, as and what Hingai said is absolutely right. This is not 100% giving the right results. But again, if we can give results up to 90% and help insurance company to reduce the dependency on the third-party administrators or those people or the workshop guys and all, that will help everyone, because then you can see that they generally become a profitable, their loss to premium ratio will go down significantly. So those type of things can be easily used in AI differently on the insurance side and all.
So is the AI using beneficial for the customer of the insurance?
Where you are using it is a more that then it gives the right result. So what I given you the example,
the right results
at this time, the examples which I given it to you, and then we were doing a POC in another country in ASEAN, not in Indonesia, not in Singapore, but the different country. And insurance company for the testing of our AI, they gave us around 50,000 accident photographs. And when we looked at the photos, there are people who have taken their own selfie with the vehicle. So difficult for AI engine to tell the defects within the individual or with the car. So those type of challenges are still there when you are implementing the technology directly. But over and above, if you ask me, if we handle the technology correctly, and instead of 100% dependent on the technology, we can use the technology to reduce some of our pain areas, then AI or any technology is beneficial. That's what I would say.
So it's a win-win for the
yes.
Insurance company and also the customer. Mr. Wood, you also talked about the area that should be prioritized to avoid risk because non-bank institution poses the higher risk without implementing the good GRC. What are the areas nowadays in 2023 that need to be prioritized, regarding our situations right now?
Yeah, I mean, this gets to the nub of the question. What is necessary first? And I go to Heng Hai's point. It's awareness and training. You know, when you get into the NBFI sector, they don't tend to have as strong a risk culture or risk training as people who are in regulated banks. And you've got a lot of investment in money and technology in banks with risk management professionals, et cetera, et cetera, et cetera. So once you get into NBFIs, and it's no fault of the people in the NBFIs, but they need much better training. And as I mentioned, you said, what are the mistakes in implementing GRC and RMF? Perhaps the biggest mistake is thinking it can just be done by hiring a specialist or by buying an AI application, which will do it for you. And it's not like that. It has to be in the culture of the organization and start with the board and the C-suite. So if I had to say, what do we need to do in the NBFI sector? We have to ramp up training significantly. We have to make sure that the overall requirements in terms of what they need to actually submit in regulatory returns are comprehensive, and that we are truly capturing the risks in those businesses. So there's a lot of work. It's really building on the excellent work that's been done, particularly post GFC in the banks, and using that as a platform for spreading it across into the NBFI sector. And I think it's quite doable. It's actually using very similar approaches to I laid out in the first session, because the risks are the same. Liquidity and funding risk exists in banks, in NBFIs. So the risks are generic, but the applications are not. That's the difference.
Okay. So talking about the risk, Mr. Wood, could this risk can be damage to the systemic level?
Absolutely, and that's where I'll give you the several examples. When Indonesia got hit by the Asia financial crisis and had a massive currency devaluation, it never really reset from there. We didn't one day go back from 15,000 to 2,800. We didn't ever go back. We marginally went retraced, but the FX never fully recovered. The GDP was hit for years and years and years and years from that systemic crisis. It wasn't just in Indonesia, it was across Asia. But in the early 1990s, all of the word was Asia tigers, the Southeast Asia tigers. They were booming. Indonesia now has got growth rates of over 5%. I think it was 5.3 last year. Very strong. One of the best in ASEAN. The growth rates were strong back then as well. But then suddenly a systemic shock hits the financial sector and it knocks the country off course for years, absolutely years. So it can hurt you at the country level, at the sector level, and also, of course, at the individual institutional level. Many of the institutions never recover. They go out of existence. So it is, I can't underestimate the critical importance for Indonesia of building on the excellent work that's already been done, extending it to the NBFI sector to ensure that the 2045 vision of a high-income country can be delivered. It's critical.
So we must work together, non-bank and bank financial institutions, to manage the GRC.
Absolutely. It's not an us v them. It's like having a common threat that we all have to collectively raise our resilience. Yes.
All right, Mr. Nick, Mr. Eng, so Mr. Ahmad, we've already know the framework. We've seen the example from the non-bank institutions, also the system for the technology that can be applied to the non-bank institution or bank institution, and especially for financial institutions to create the good GRC system. And now we will continue our session to, once again, Mr. Nicholas Wood will also present the presentations after this panel discussion. So Mr. Wood, The time is yours.
Thank you.
Thank you very much, Pak Aldi. Okay, we've had the panel session. Thanks so much, Heng Hai and Amod, and please stick around for the Q&A. I'm sure there'll be plenty more at the end. Now, we're now going to go on the implications for regulators and supervisors. I'm going to spend 20 minutes on this. I've actually got written down here that my deadline is 3:35 Jakarta time. I hope that's correct, Pak Aldi. So 20 minutes is the max I'm going to cover here. And I first of all wanted to reflect, what have I learned from Indonesia, my experiences in GRC? My personal experience has been, I learned more when I got things wrong than when I got things right. And in any career, you get a lot of things wrong along the way. But hopefully, as you progress, you don't make the same mistakes again. You learn from that, you gain wisdom. So I'd like to share some of the sort of insights from 1985 onwards, and what I've learned on what can go wrong and how to mitigate it. Now, my first observation is that corporates, or non-banks and banks, have one thing in common. They have a strong profit incentive, a desire to maximize returns, maximize revenues. And the flip side of that is to minimize cost, So one of the things I've seen, not just in Indonesia, and I think it's much less so now, when there was long period of foreign exchange stability, corporates and banks looked for the cheapest currency to borrow. When I say cheapest currency, the one with the lowest interest rate. The yen, the Swiss franc were typical examples in the past. And it didn't matter what they were using the funds for. They were actually using it to fund rupiah receivable activities, nothing which had Swiss francs, nothing which had yen. But they were running a foreign exchange mismatch to take the benefit of the low interest rate cost. Now that got many institutions into trouble. And it really exposes a common theme of a risk driver, which we have to look out for if you're a regulator or supervisor, is whenever you're in a period of low interest rates or a period where there's a huge pressure to find the lowest interest rates, that can result in excessive risk taking in terms of pursuit of very low cost borrowing, even if it's in a foreign currency, or trying to get high yield investments. And I gave the Japanese example of seeking government security yields, even if it's 50-year tenor, 50. So chasing yield on investments and chasing lower cost and taking excessive risk. Not just Indonesia, this is something which prevails almost everywhere and is a cause of stress and needs to be watched out for, particularly in NBFI sectors. If you have a pension fund and they have to deliver returns of a certain level to pay the pensions, they'll probably could use excessive leverage, which gets to point number 2, to improve their returns. What else have I seen in Indonesia? Exporters. Exporters selling US dollars forward to benefit from premiums, but doing far more than their export receivables. Sometimes 10 times, sometimes 20 times with different banks. Again, this is nothing to date. This is way back in time. But I've seen it around Asia in the bad old days, pre-Asia financial crisis. Most of this has been cleared up. But the general point I wanted to make was a warning signal, risk driver, is use of leverage to improve returns. Something that supervisors, regulators across the sectors need to look out for, this particular aspect. And the final one, novelty factor. Everyone likes to try something new, whether it be crypto, whether it be a new payments company, whether it be a new app, whether it be a new emoji. The novelty factor and ease of accessibility means people will want to do it. And they can then get into inappropriately understood products. They could be credit products, with the flip side of financial inclusion is you might get a lack of awareness. If you have a huge acceleration in financial inclusion without a huge improvement in financial literacy, you'll get novelty factor losses. Sometimes people call it school fees, paying school fees to learn something in a very hard way. So these are generic things. It's not the individual cases. These are things that happen. They don't happen just one year. They happen time and time and time again across every market. So it's something to watch out for, particularly now as we've moved beyond the banks into the other areas of the financial sector. What's coming next? Well, what would I kind of look out for? What do I think could be a little bit nervous? And I'm looking across ASEAN here for ideas. One area I'm slightly nervous about, buy now, pay later. It's seen massive growth. These are the market shares of personal loans. Philippines is by far the highest. So this is where there would need to be particular attention. Indonesia is in the pack, higher than Malaysia, less than Singapore. But it's an area that has seen very rapid growth. What are the risks and are they properly boxed in across the sector? I'm not saying there are massive risks. I'm just saying it's new, it's growing fast. It needs to be looked at across ASEAN. And use of crypto, in terms of what are the usage, of course, we'll get into a little bit later, but already in some parts of ASEAN, we are seeing tourists using cryptocurrency stablecoins for transactions, mainly villa transactions, particularly tourists from countries where sanctions have been imposed, like Russia. So we may think that crypto is only in the investment area, maybe coming now into some of the investment companies, savings products, but no, it's already in the transaction. It's already in the transaction field in parts of ASEAN. So I do think these are areas, and that's just two, but wherever we see something new, remember it's the novelty factor, something new, growing fast, it's a bit of a red light, in my view, in terms of having to look at it just based on what's happened in the past. Now, financial sector risks are evolving. All I'm showing here is from the UK, and the sort of range of companies that make up the percentage of assets held, the range of financial intermediaries, you can see there's a big mix of different types of financial intermediaries holding onto assets. So it's not enough, even though the banks and building societies, the deposit-taking companies remain the main holders, they're not the only holders. And the other areas are growing and expanding rapidly in multiple areas. So we do need to look at the supervisory scope and to make sure that the coverage is extending in line with the way the sector is evolving. It's difficult because it's evolving so fast. And it's driven by some great things: financial inclusion, customer experience, competition, all good things. But there are new risks. There are new risks because there are new players. These are things that are well understood in the banks, not so well understood in other parts of the sector. Now, it's quite difficult for supervisors to keep up with the pace of change in terms of the speed. And this is just a sort of a pictorial of the PRA, and it's got senior supervisors across all of these areas: banks, building societies, credit unions, etc., etc., etc. But on pension funds, there's a memorandum of understanding, so it's a slightly different coverage model. It still has coverage, but it's slightly different. And I'm only raising this because when you have different types of coverage, it does raise the possibilities, vulnerabilities for mishaps. I'm not saying it's the cause. I'm just saying look at the scope and the coverage to ensure it is properly comprehensive. Because my experience is that if it's all under one place, where you've then got the specialists absolutely there focusing on the same risk across multiple institutions, it is actually a better framework in terms of reducing risk of mishaps. That would just be my observation. So there are pluses I mentioned, fintech, and they're mainly pluses. It's been an incredible boon and benefit, the fintech revolution. It reduces costs, frictions, increases efficiency, competition. It broadens access. But there are a lot of risks coming in. And there was a neobank study. Now, neobank is not a licensed bank, but it does bank-like services. Could be payments. It could be a part of the banking product set and services, but it doesn't have a bank license. And a study of those type of companies has revealed there's higher risk taking in retail loan originations. There's not appropriate provisioning. There's an underpricing of credit risk. There's higher risk taking in securities portfolios. There's inadequate liquidity management framework. So the neobanks, let's just call it NBFIs, involved in part of the banking services without bank licenses, have got elevated risks. So it's an area that does need to have more vigilance. And when they take more risk, guess what happens to the banks? They take even more risk too, because they have to keep up. They have to try and maintain their market share, maintain their returns, and they fight even harder for the same customers and same services. So the supervisors need strategic priorities, calibrated coverage. The right level of coverage is not one size fits all by any means. It's not one speed fits all. It's really working out the developments that are taking place, the speed of them, and making sure that the coverage comes in alongside. So retaining and building the bank sector coverage, I think Indonesia should be absolutely proud of their record, particularly since the Asia financial crisis, which is a long time away now, all the way back to 1998. Indonesia should be very proud of the way in which their regulatory supervisory has worked. And it's a question of building on that strength, being at the forefront of what's new and emerging, and taking advantage of international policy dialogue, what Heng Hai was referring to, supporting competition and dynamic markets, yes, but making sure the right level of vigilance is there. So a couple of things I just want to focus on before we close. The importance of stress tests. It's really important that it's not one size fits all, that we get the right level of stress tests for each of the levels of maturity. Established banks obviously need very mature, quite complex stress testing. Applicant banks need much lower. New banks, again, stepping up slightly, but less than the established banks, et cetera, et cetera, et cetera. And one of the things that's happening with stress tests is that they're now needed for multiple regulatory returns. And rather than being done in isolation, in a silo, they now need to be, they have multiple uses, they need to be run centrally. So the institutions themselves need to have the capability centrally to run multiple stress tests for whatever the requirement is. So I'm just giving a flavor of what's going on in the UK. They've already got 3 types of stress tests for banks and building societies, annual concurrent stress tests. Firms that are not part of it have to do their own stress testing, and every other year an additional scenario, depending on what the biggest emerging risk happens to be. So very strong regulatory stress testing backbone. Of course, the institutions still run their own stress tests. Insurers, rather new, assessing the sector resilience to severe but plausible adverse scenarios. Now, for these insurers, they have to develop their own stress testing program. For the biggest insurers, there are stress tests that are run with the PRA on a biennial basis for a number of the largest insurance firms. Those that are not covered have to do their own stress testing. Very important area. They probably need help, a lot of help, in implementing these technical skills. Central counterparties, this is really getting into areas that Heng Hai was covering as well. When we're clearing payments, etc., through central counterparties, we also need to stress test them. They are like the spine of the financial system. And if they break down, these societal and economic consequences are extreme. And so in the UK, the bank has launched its first public supervisory stress test of these central counterparties. Crypto and DeFi, now it's fairly new. The current assessment is that this is in the UK, the direct risks to stability are limited, given to the relatively low side, but this will change in coming years. And the evolution is quite clear. It starts as speculation, it then goes into investments, and it then goes into payments. And we see this across Asia and ASEAN too. We've had examples of all three of these areas that are developing. The supervision, the regulation will need to step up in calibrated to the size and the potential impact in the marketplace. So a couple of regulatory returns. ICAP, this is a very important disclosure that is run by the supervisors, looking at the capital adequacy of banks, very thorough. And what are the areas that I think central banks and regulators should focus on right now? FIs completing ICAP for the first time or outside of the ICAP umbrella completely. Should they be inside? Should they be in? What is the right buffer for those newly submitting ICAP returns? For banks that are already in existence, they're going through a complicated balance sheet transition. The pandemic meant they got a lot of government securities, less loans. Now the loans are coming back. It's a complicated transition. Is the growth too fast of the loan book? Are the loans being priced for risk? Really needs to be looked at. And impact of interest rate changes. We've had the highest inflation for 40 years, the biggest interest rate jump, the quickest jump, again for all the way back, I think, to the 1980s, 40 years again. How is it impacting the balance sheet? Similar on ILA, look at which is liquidity. Is anyone completing it? Is it a requirement? What is the right buffer for liquidity? What is the right loan to deposit rate ratio as the balance sheets evolve? And what is the impact of liquidity in terms of collateral management, and what's the skill level, in liquidity and collateral management? Final slide, regulatory technology. I think there is a huge change taking place. It's like a seismic change. We started off as manual reports. We then had data-defined templates. I think we're moving into pure data, where regulators just get a data dump from financial institutions. We're moving to a world where the regulators and supervisors may know more about the banks and the financial institutions than they know about themselves, because they'll have the same data, but they might have the supervisors might have more advanced analytical capabilities. So we're moving to a different world as we transition from manual to data-defined templates to data dumps, and it's going to create a radical new approach, I think, to supervision. I'm going to finalize on this slide, and just like to say that I've really emphasized, I hope, the importance of education and training across the sector, and awareness. And in looking at the Indonesia landscape, it really needs to be broad-based. You know, covering OJK, the banks, the fintechs, the non-bank FIs, even the unis. It's a level of holistic awareness improvement, which we think is the right way to do this. And LIBF, I know, with Kawi Ang, would be delighted to try and help support in any way we can. I'll hand it back to you, Pak Aldi. Thank you.
Thank you very much, Mr. Nicholas Wood, to once again elaborate to us about how to manage, how to create a good GRC system by creating strategic priorities, calibrated coverage, and create own testing to then can implement it, the best practice of GRC. Thanks once again, Mr. Nicholas Wood, for your presentations. And about the presentation, I would like to ask a question. You mentioned about ICAP, ILAB. Is there any standardization that FIs in a company could use to understand more, to implement the best practice of GRC in the company?
Yeah, I think, first of all, I'm a big supporter of ICAPs. Having been involved with them personally, I find they are a fantastic way of educating the whole company about capital risk, capital adequacy, and driving a risk culture. So I'm a huge supporter of it. Yeah, go ahead.
How about the ISO 222?
I'm less familiar on that. I would pass over to Heng Hai on that side. But just on the ICAP side, I think the challenge we have, because we would already have that in Indonesia, the challenge is on how do we build that beyond the banks in a meaningful way into the non-bank financial institution sector. You know, something which is slightly scaled down, but as impactful in driving higher standards and higher knowledge. But let me pass to Heng Hai on the ISO part of that.
Okay, Mr. Heng Hai, go ahead.
Yeah. So the view on ISO 222, I think the biggest driver and the trends that we are seeing is that with the swift announcements that they're going to move the current MT messages, which is ISO 15022 to ISO 222, it's going to be an area whereby countries globally will be getting more acclimatized to that standards, and there's still a huge evolution required. Within ASEAN, it was very clear that the current ISO 222 is very much Europeans, American standards. And we were still hoping, we have been working very closely with the ISO RNG, that the Islamic banking angle of the Muslim community has not been fully addressed. And I think that's one area, if Indonesia can take a lead on it, it is going to be very fruitful. We have been talking to the Malaysians via PayNets, and I think BI with the implementation of FAST now that it is I would say it's in a very fabulous stage whereby you have more than 100 over participants. This may be one area that if the Indonesian community can actually chip in and help, I think it will be fantastic and useful.
All right, thank you, Mr. Heng Hai, Mr. Wood. Mr. Ahmad, you would like to add the answer?
Yeah, I can add to ISO 2022 because I was involved in development of these messages earlier. I was globally co-chair of ISO 2022, representing Singapore government over there. See, the standardization always helps to everyone, because then it will be easy to communicate with each and other party, other institution and all. So adopting those type of messages will be key for ASEAN countries as well, so that your cross-border payment, cross-border transactions will become very easy if everyone start implementing those standards and all. And when we were developing these standards, the standards have been developed in such a way that 95% of the things will remain the same across all the countries. and only local customization, they can do it only 4 to 5%. So with the minimal changes, anyone can easily implement these standards and all. And again, these are the standards, right? No one is asking us to use the same gateway and all. So countries can use their own gateway to use these standards. So yeah.
Yeah, maybe I'll add on to what Amok has shared, and I think Amok's just raised a very good point, whereby he was running the security sec, and one of the key things that we are seeing developing in European central banks is really the whole reporting, auditing frameworks that needs to be reported by all the countries that is in SIPA. And now with ECB launching their instant credit transfer scheme, I think that there's a lot of potential good material and resources. And this goes back to the earlier point whereby aligning ourselves with the global movements, making ourselves aware of the global developments. There's a lot of readily available templates and formats that the Indonesian or the whole ASEAN can actually collectively adopt and adapt accordingly to help to manage the, especially even for OJK, to say that how do we want to report. We are also seeing very interesting developments from the Chinese in terms of stock exchange. How do you do your bond price reporting, etc. So there's a lot of good frameworks, programs, the short better words, that is going on globally, whereby definitely it will help everybody in this this GRC journey. And I think this echoes some of the concerns that was raised in the Q&A, that there's a lot of programs, you know what I mean? And a lot of programs locally you may not have the expertise. Also, I think these are areas whereby some of these global resources or knowledge can be useful.
All right. Yeah, it is also interesting that this GRC system always evolving every time, as Mr. Nicholas would present earlier. Then we've already have a lot of questions towards our panel discussions and also Mr. Nicholas' presentations. We've already got 32 questions from the participants today, and we'll try to answer one by one. And I would like to remind again, each participant, you may type your question via Q&A section features by simply type your name, also name of your institutions, followed by your question and to whom your questions is addressed to. So we move on to our Q&A session by answering the first question from Mr. Rahmat Widianto from BBRI, Bank Rakyat Indonesia. This question is addressed to Mr. Nicholas Wood. The question is, in your perspective, could you please give a specific example about activities that represent GRC? Yeah, may
sure. I mean, the most obvious ones are anything that is on the balance sheet, right? Anything that financially comes on the balance sheet is within the sphere of all of those risks that I highlighted in the bubbles. Now, you could also have someone making an inappropriate interview with a journalist, which might have reputational damage, et cetera, et cetera, et cetera. But really, we're talking about, in this context of this seminar, we're talking about the balance sheet activities. So if you're originating a loan, if you're bringing in a deposit, if you're entering into any kind of transaction, a financial transfer, that is within the realms of a GRC activity as we're defining it for this particular seminar.
All right. So I think Mr. Rahmat Widianto can also understand more on your slides of presentation that we will share after these webinars. Then we move on to the next question to Mr. Lim Eng Ai from Mrs. Nurina Indri from BTN. The question is, currently in practice, banking has begun to implement 1.5 lines of defense. Is this more effective for banking? Mr. Lim Eng Ai, maybe Mr. Wood, if you want to add some points too, you may answer it too. Mr. Lim Eng, go ahead. You first.
Sorry, I'm trying to browse the question. What was the question again? Sorry.
1.5 lines of defense. Is this more effective for banking?
Nick, you want to help me with this?
Yeah, I will help you with that. Because it's smaller, lower, doesn't mean it's better. In fact, 1.5, the thing I don't like about it most is the 0.5. 0.5 means you're only half responsible for it. That's not good enough. 3 lines of defense is there for a reason. You know, the first line are the originators of the risk. The second line are the risk specialists who set in place the framework. And the third are independent audit. So 1.5 is not better, it's much worse. It's much worse.
Much worse, okay.
Much worse.
So 3 lines of defense.
It's like having, you know, if you've got a football team, it's like having 1 defender. I'd rather have 3 defenders, thank you.
All right. So 3 lines of defense is important to create the best framework to risk appetite.
Yes, not 1.5. Yes.
Statement. Manage the risk.
Maybe I'll supplement. I think the key thing is not about 1.5, but also we have to look at it from 3 spectrums, and the 3 spectrum is always the doer, the checker. You need someone else to check. So it's more to have a structure whereby you have that accountability set. You know what I mean? Then it's more about the depth that you go in. You know what I mean? So I think we have to look at it as a total framework.
The total framework is 3 lines of defense.
Yeah, but just to clarify, this doesn't mean like every time you sign a check, it needs 2 people to co-sign. We're talking about these big risks that could affect the future of the company. So we're talking about identifying the biggest risk. Is it a funding risk? Is it a capital adequacy risk? And for that risk, we need the 3 lines of defense. It's not for every single transaction in the bank. So let's get perspective around this. It's for those big risks that were in the bubbles that I highlighted.
Then you can elaborate the quantum of each line of risk.
Yes, correct.
Let's move on to the next question to Mr. Amor Dixit from Mr. Joseph Chang from OCBC and ESP. The questions are, I'm glad you brought up about third-party risk management, TPRM, which is applicable to all of us in the webinar. The more we depend on third parties ranging from its service providers to administrative functions within the organizations, what are the lessons learned has the insurance industry experienced in this space?
Yeah, I would say that there are challenges, different challenges for the different organization when they're managing the third-party software provider or third-party administrator. So best thing to do is to have a right contract with the third-party providers, have basically quarterly review with those guys just to see that we don't want any surprises coming from those guys and all. That's the second one. And the third one is that how you can also put some audit and internal audit on top of it to also monitor other than your normal day-to-day team looking at it. So these are the things that we can do, because it's very difficult for any organization to do everything on their own. The reason they are going with the third-party providers and administrators is because if they start building everything on their own, then what will happen is that it will take years for them to develop those skill set and all this, and the cost is very high of doing that. So it's always it's a beneficial, it's a cost benefit analysis when organizations take the decision to go with the third party providers. But again, those type of things, if you can implement, then it will be definitely helpful for the organization to monitor and manage the risk in a better way. That's what I think.
Okay, so the cost it will be more. It will be higher if you do not use the third party.
I think, go ahead.
Yeah,
it's basically a case by case basis, as I mentioned, right? Because to have that type of expertise, not only cost, but also the expertise and all. Because what it brings to the table from the third-party administrator or third-party software provider may not be available within the local country and all this. So for example, simple like AI, right? It takes so much time and efforts to build AI engine. So what we did, I will share with you our experience. We have employed around 15 plus engineers just to collect all the accident photos globally, which are freely available to train our engine. And we have 3 servers dedicated to only collect the data of the accident images so that our AI engine can be trained. So where the organization is doing this, right? You think about any insurance company putting the efforts to do this, it will be difficult for them to do that. Whereas we as an insurtech provider, a specialist in this area, can do it differently. So where we can use those type of things, but as I mentioned, right, have to have a right contract with those guys, quarterly review and a proper audit will definitely help to monitor and manage the risk with the third-party providers. Yeah, Henga, you wanted to say something.
Yeah, I think although the question was from insurtech's perspective, from I think FI, there's so many services that's being outsourced, and experience that we are seeing is that vice versa. I think that the general rule of thumb is really you can outsource, but the accountability lies with the FIs. And to manage this, typically it means that the third party needs to go through a very stringent audit process, like what Amor has mentioned. I think the key benefit of getting third party is really get the best of breeds and best solution providers out in the market to mitigate the risk. And I think the risk management frameworks is important. We can see implementation whereby in UK, the open banking implementation, FCA under Bank of England do have an entity that will go and audit such service providers, those that is using the open banking services. In Singapore, the banks have gathered together under the Association Banks of Singapore, come up with what we call outsourcing service providers audit reports, whereby they will set the standards of the audit report requirements so that third-party service provider, I think a good typical example is, for example, I'm a printer for the bank statements. I will be doing the bank statements printing for a lot of banks. And the biggest concern is always how you handle all these private informations. The audit process, once it conforms with these guidelines of OSPAD, in short, outsourcing service provider audit report, they can use this same set of reports to actually share it with, there will be a third party that will be commissioned to do it, but then you can share this report with the FI so that the risk can be managed. I think this is actually to create a win-win situation for the banks, for the regulators, and also for the third-party service provider, so that you all can make the maximum benefit out of the whole scheme of service.
All right. Mr. Wood, where is exactly the position, the stance of the third parties on the front?
Answering that if possible. Ahmad, can you take that one?
Again, as I mentioned, right, wherever for the banks or a financial institution, it could be the same. But when you look at the GRC, on the GRC side, some of the points that we discussed today on the managing the risk, different type of risk which are there as a part of GRC, then digitization could be the new one which is coming in, how to handle that. And also third is the data protection and those things. So these are some of the themes that we see as a part of GRC to handle or the manage things. I think it's a combination of both. You have to have your own team plus third-party experts or third-party providers to manage these things so that you can implement these things much faster. And as I mentioned earlier, is a cost-benefit analysis for this. Instead of we doing it, what is, if we start working with someone else, can we reduce the cost or the losses, right? By putting some experts on that, I think we should go ahead with that. It's ultimately the decision One is how can we comply with this regulation? That's the first thing. And the second thing is how fast and how cost effective we can implement this.
All right. I believe it answered the questions. Let's move on to the next questions. To Mr. Nicholas Wood from Mr. Andri, BTN. The questions are, he has 3 questions. The first questions, what are the trends and challenges of implementing GRC in the current era of digital disruption? And the second questions, what is the focus of GRC this year? Digitalization, ESG, or data security? And the third question, how is the strategy so that the integration of the GRC can drive businesses' achievements and remains aligned with the values of good governance?
Let me start with number 3 first, because it's a topic that's close to my heart. If you really understand your risks and you've got a very strong risk management framework, you're able to do something called balance sheet optimization. Mm-hmm. The more efficiently you can manage those risks, it gives you more capacity, more capital, more liquidity, more leverage exposure to put to work. So the strategy of integration, if you think about it this way, if you're really knowledgeable and expert on risk management, mm-hmm. you can actually drive much higher level of return by dynamically moving the capital where it's best deployed, liquidity where it's best deployed, et cetera, et cetera. And my classical example is JP Morgan, who are experts at dynamically moving around these resources with very, very strong maintenance of ratios. So good governance is a prerequisite for delivering the best returns over a long period of time. Stable returns, not volatile banana skin returns. Mm. So that's number 3. GRC is a prerequisite for excellent balance sheet optimization. Now, the challenges of implementing GRC in an era of digital disruption are that, we've got new players in the market, for one. We talked about that we've got new NBFIs, we've got new counterparty risks. We've got risks moving from players who were very familiar traditionally managing those risks to other places. So we've got a different home for some of the risks in the marketplace. So it's understanding, one of the challenges is understanding, what is the dimension of the risk? Is it always going to stay in my institution? Is it moving off to somewhere else? And should I encourage it to move off, which goes back to that third party question? Is it something that's better removed from my horizon to someone who can possibly manage it more effectively? Now, the main focus of GRC this year, given that digitalization, ESG, and data security are almost like perennial, you need to look at them all the time. The biggest change this year, I think, is the impact of high interest rates across all of the markets, high inflation, how that's changing customer experience in terms of cost of living and their spending habits. Mm-hmm. So GRC is having to take account of the impacts of the 40-year high inflation across the marketplace. That's the new thing that's coming through, rather than these more generic issues.
Okay, so basically we have to be more focused about the macroeconomic situation around the world globally in this era, rather than digitalization, ESG, or data security.
Yeah, no, I'll build on that because we're into a period now of quantitative tightening. Okay. That's when the Federal Reserve in the US is reducing or not growing the money supply at the same pace. That doesn't just stay in the US. That cascades around the world. Mm-hmm. And sometimes we call it a taper tantrum. In the past, it caused foreign exchange stress. It caused interest rate stress. Mm-hmm. So we have to be aware, like you said, of the macro environment. If it's extreme, if it's fairly stable, no worries. We can focus more on these generic issues much more. But right now, we're in a turbulent world right now. Very turbulent.
All right. Thank you, Mr. Nick, for the answer. let's move on to the next questions. And this person has 4 questions to Mr. Lim and I. The question comes from Mr. Edwin Ronaldo from OJK. The first question is, you prefer answer one by one, or I mention the 4 questions, then you answer? Mr.
You go ahead. Yeah, you go
Okay.
ahead with the question. Yeah.
Okay, the first question is, how does the Singapore regulator formulate a supervisory methodology for all entities in Singapore? This is in view of the massive development of digital banks. The second question, what is the Singapore regulator supervisory methodology for NBFI entities? The third question, can the GRC framework in Singapore easily adjust to incidental conditions? And the fourth question, has Basel III been fully implemented in Singapore? And the note, please provide an explanation.
Yeah, so I think for question 1 on the supervisory frameworks, it's really where possible they will enact act to manage it. As what I mentioned during the panel discussion, if you are a digital bank, based on your banking activity, you are still deemed as a bank. You will be audited by the regulator as a bank. For the NBFI, for the non-bank, depending on your business activities, there's 6 different class of services when it comes to payments. One of the things that we are seeing is that over the last, and they have set up a team called Payment Supervisory Team. This is really for any MBFI to say that if you want to do a wallet solutions in Singapore, for example, they have a set of governance or questions or checklists that they need to go through with the MBFI entity. They have to accurately address and make sure all the governance frameworks is adhered to before they will be granted the license. Singapore being a very open market, so and this is really to answer some of the questions that I'm seeing in the Q&A, is that there's really a lot of wallet solution providers, a lot of big F&B outlets, or even big conglomerates in Singapore. They just wanted to offer their own loyalty program, their own wallet, their own payment capability. There's a huge backlog of applicants for such MBFI. And some of them has been in the queue for even a year. I think that there's a requirement to actually look at governance and service providers that's really coming into the market. And I think this is the reason why, as what I mentioned during the plenary sessions, these new entries is going to create a whole ecosystem. It's important that it's keep in check, and the intent is not to create any potential systemic risk to the Singapore financial system. In terms of the GRC frameworks, to look at incidental conditions, if you're looking at from payment perspective, a lot of those incidental conditions is really in the situations of potential fraud, system compromise. There's a whole rule book within the system itself on how that will work. And in terms of industry participants, the main fronting party is really the Association of Banks, so that they can help to manage the risk, or at least the public security side of the risk. The rest is really as and when incident has come, there's no choice. If it can be absorbed, the risk can be absorbed, it will be absorbed. Then risk decisions will come. I think one of the good examples that we've seen in Singapore is really there was a local bank that was targeted by the Europeans on payment infrastructures. So as part of the mitigation that was done post-event is that today, if you want to add a registered payee, there's a cooling period of 12 hours before you actually can effect the payee and you make the payments. So the frameworks provide a structures of emergency response, but the adjustments will usually be a post-event that have to manage the residue and provide the propose the mitigation. In terms of Basel III implementation, to the best of my understanding, banks are ready, but not all banks are ready. So, they will have to most likely present their roadmap to fully comply. For the details, I don't think I'm the best person to represent the whole industry or the regulators in Singapore to answer. But that's our understanding based on our engagement within the industry. Hopefully, I address all the questions appropriately.
Yeah, I believe you address all the questions and give a slight good example for the question from Mr. Edwin Ronaldo. All right, let's move on to the next questions from Mr. Endang Kiswara. It is not surprising that cases of fraud against consumers are the results of traffic monitoring or service providers who are not able to properly investigate. The questions for Mr. Ahmad Dixit: can the bandwidth localization of a country can be helped to guarantee the validity of traffic control systems for market players?
See, it's difficult to put link that with the insurance on the traffic control system. This is what I think. But where we can use some of these things related to these data points on the traffic control system and all. One is in one country, what they have done is they are looking at basically some of the defaults and all, or if the people are breaking some of the rules and all this, they put those points in the insurance policy. They give some discount or they penalize those drivers. That's one. The second one is looking at how you drive. So instead of going into that particular traffic monitoring system, what you can do is you can launch a new policy which is called as a usage-based insurance, which is based on the driving behavior of an individual. You can launch a policy, and that's how what we can do is we can differentiate between the good drivers and the bad drivers. And I'm happy to answer this because we are the one who launched this policy in Singapore. We are the first ones to do that. And we are now working with a local insurer in Indonesia to launch the similar program in Indonesian market. So it's called as a Parrot How You Drive policy in Singapore, where it differentiates between the good drivers and bad drivers. We don't penalize bad drivers, but it's again basically help them to understand the driving behavior. So we are using these things differently into this, but again changing the infrastructure at the or the country level and all. I think that question is not for me, difficult for me to answer, but I can say the variant of that is how we can use some of the data points to launch new policy, and that's how insurtechs like us, we work with the insurance companies to launch new policies. It's not the same policy what you get in the market by everyone, but then adding those additional data points and launching the policy, that's a key. We are working with another insurer in the region, and it's a simple example I will give it to you. It's more for a property insurance, commercial property insurance. We are looking at how much time it will take for your ambulance or a police van to reach the place. Based on that, we are doing the pricing of a policy. So those type of things, additional things we can build in, data points can be built to come up with the policy, which is useful for a policy holder or an individual. So that's how we are using data points. I think it's more of a using data points by the local insurers, working with the regulators to launch the new policies. I don't know whether I have answered it, but because it was a very open question. So,
so once again, understanding more about the customer behaviors of
correct.
Okay, thank you, Mr. Ahmad. Let's run quick to the next question, so because we only have 4 minutes left. The question for Mr. Nicholas Wood from Mrs. Firna Medina from Alo Bank. The current 3 lines model is slightly modified by bringing the first and second line closer. Is there any way to bring the first and second line closer without risking the independency of the second line? The second question is how critical it is the role of top management in implementing the 3 lines model?
Yeah, I think on the first question, you don't want to blur the lines. One of the biggest flaws you could make in this whole area of GRC is if people are not aware of their responsibilities, the separation of control. The reason we have 3 levels is that they are looking at through a different lens. You've got the originator of the risk, lens 1. You've got the controller of the risk, lens 2, and you've got the independent auditor, lens 3. You can't sort of have one foot in the origination camp of a risk controller. That's not a good thing. The independence is there for a reason. Now, the skillful risk specialist, I've worked in line of defense too myself, and the skillful way of working with the first line is in helping the first line to understand how to do business in a less risky way. So there can be some consulting advisory area, but there should not be a change in the authorities. They must be very, very clear. Very, very clear.
All right. So you cannot just use the first and second line, but also the third line altogether.
Yeah, but you should not blur them. You shouldn't have the second one, 50% of the time they're doing the first line. You know, they need to be in that second line. That's it. Where you get errors, where you get losses, mistakes, is when you get blurred responsibilities. You know, if you ask who's responsible for liquidity risk in this bank, and 5 people put their hands up, you've probably got the wrong delineation of responsibility.
And the critical of the role of the top management.
Oh, I can't estimate this more. It is so critical. The entire culture of the bank is basically in the mannerisms, in the words, in the writings of the chief executive and the board. They set the risk tone for the organization. You can forget about a risk management framework if you have a CEO, for instance, who doesn't believe in risk management at all. Because it will be obvious. People will know that immediately. So it's the most critical. It's without the top leading from the top, you can't have a strong risk culture in an organization.
Okay. Thank you, Mr. Wood, for the answer. I hope it answers the questions from Mrs. Firna Medina. Okay, let's move on to the next question to Mr. Lim Eng Ai from Mr. Irsyadul Fahmi. What are your thoughts on the roles and responsibilities of the risk compliance and audit units in order to implement GRC so that GRC can be implemented despite multiple perspectives?
And I think Nick will have answered the question in the earlier response, whereby as what he has articulated, that 3 line of defense, and I actually wanted to echo his viewpoint, is that this is really a tested framework and process whereby you have someone doing it, you have someone checking on it, and a third party, another pair of eyes to look at that process. Of course, the challenge, noting that the banks is very lean nowadays, is that how do you actually craft out the scope of work of the various party. But I think and let's go back to the reiteration of and this is really not a one-time exercise, whereby this is a journey, a culture, and that's why I think Nick emphasize the support of the senior management, whereby it has to be part of their DNAs, and risk in our line of business, payments, financial sectors, or even insurance is really the reasons of the business itself. If you look at financial sector, it's about risk and return. You know what I mean? You want to take a bigger risk, then you have a better returns. So having that checks and that framework is going to be fundamental. There's no one size fits all answer. I think Nick has also mentioned it in the earlier discussion, whereby through trial errors and through experience, you know what I mean, through that journey of yearly audit, yearly findings and tuning, it's really that journey that you will actually do to where you want to achieve. As shared, this is a journey that the banks and the industry just have to go through, and the reason why we're here is really we are practitioners, and we think that if you need help, reach out to us. we are more than happy to share our experience.
Yeah, just to tip on this, on the ICAP, is I think the ICAP, the capital adequacy assessment, is where the supervisors look at your risk culture. They look at how it's actually embedded in the organization. They don't just look at the numbers. They look at how you work. Have you embraced it fully, enterprise-wide? And one of the ways, just a tip, I think, for a bank to really see how well it's got embedded is to get involved with the ICAP. You know, if it's just being done by the line of two, the risk people, it's not going to be good. It's got to embrace all three lines. It's got to be enterprise-wide. That's my litmus test. Have they got a risk culture or not? I can normally see it from their ICAP process.
All right. So back again to 3 lines of defense that should be implemented of giving the best practice of GRC. All right. Yes. I hope that answer the questions, and let's move on to the last questions for Mr. Ahmad Dixit from Mr. Rizky Ashari, PT Asuransi Jiwa Syariah Alamin. It is a Sharia insurance company, I believe. The questions is, we just passed the pandemic COVID-19 situation, and we all know that the normal activities has just begun. There are many rumors about recession. It means there will be many economic problems that will arise, such as bankruptcy or business transactions, disputes, either internal or external of company, even if we already have conducted all compliance in accordance with applicable regulations. In economic side and your suggestions, how do we prevent from that problem, especially in insurance sector?
See, one of the things when I was talking earlier, when Nick asked me this question about what you see as an insurance landscape, which is changing. And when answering that question, I mentioned about some of the key themes which are changing the insurance landscape. And as I rightly asked the question, the climate change is one of the things that is basically changing the insurance landscape, because what's happening is that it is becoming increasingly pressing a global issue, and insurers are basically adapting their offerings to reflect the growing risk associated with the extreme weather events or natural disasters and so on. So if you look at the pandemic case, in one of the countries in ASEAN, they launch a policy over there. And it was the policy to help for COVID-19 situation in that country. But what happens is that there were fake claims being made, and the company was still having some challenges to recover from the fake claims coming on the COVID-19 side and all this. So if you look at, right, something is doing, the people want to do something, or the insurers, regulators wants to do something, but if the people are doing it, looking at it very differently to earn money by the fake claims, by the fake policies and all, it will become a challenge on that side. But again, I think it's the best way to do is to basically see what type of risk we are entering into, and then implement that as a part of your GRC framework. And implementing GRC framework can be done differently, through identification of the risk, how we can put the technology to support it, what are the things can be done on the data protection, the privacy policy, those type of things can be implemented along with it will help. But again, the case which I just give the example of that insurance company is still struggling because of that. So those type of challenges we will see in the market and all. But again, everyone should be cognizant of the fact that when they are buying such policies or they are doing something like this, right, they need to follow some of the best policies and the best, I would say, technology and all to monitor those things so that it will not happen again, I think. Yeah.
Is there any particular concern or suggestion to the Sharia insurance company?
But the Sharia, way the Sharia is being done is basically you are giving back something to the industry and all. So which is a great way to manage the policies and all. So I don't have, I think I like Sharia policies a lot because it's not done for a profit. It's basically giving something back to the society. So I'm a big supporter of Sharia policies.
All right. Basically, we face the same challenges in the era of 2023, digital disruptions, and also maybe recession threat on globally. Thank you, Mr. Ahmad, for the
But I would
answer.
like to add another thing while you're talking. I was also thinking it's basically it's critical for the insurance to remain agile, resilient, and the customer focus to thrive this in the competitive market. That's the important thing for them to monitor and manage. Yeah.
All right. Thank you, Mr. Ahmad. And that concludes our Q&A sessions. Thank you very much, Mr. Nicholas Wood, Mr. Lim Eng Ail, Mr. Ahmad, for your answers towards all the questions. And distinguished guests, ladies and gentlemen, thank you for your attention and enthusiasm. But we are really sorry that we cannot deliver all the questions due to our limited time. And ladies and gentlemen, before we end our session today, I will once again invite Mr. Nicholas Wood, Mr. Lim Eng Ail, Mr. Ahmad Dixit to deliver closing statements of this webinar regarding our topic about GRC. Mr. Nicholas Wood, you may go first, please.
First of all, delighted to have this opportunity and huge thanks to OJK and to yourself, Aldi, for moderating. A very short statement. I think the financial sector GRC resilience is key to Indonesia delivering on its 2045 high income goal. It's absolutely key. And we stand ready and LIBF to support through training, awareness across the whole sector in any way we can to help to deliver that goal. Thank you.
Thank you, Mr. Nick. Thank you for this very insightful session and also your closing statement. Let's move on to Mr. Lim Eng Ail. Please, for your closing statements.
Yeah, and I think to echo what Nick has mentioned, and I'm going to just comment it on payments perspective, having the right risk management framework, primarily looking at it from a real-time payment system perspective, is going to be fundamental for Indonesia. Noting your numerous collaboration that you're working on, looking at your potential systemic risk and counterparty and liquidity risk and settlement risk is going to be a key consideration or a key factor that will affect your journey into or to interlink yourself with the financial sector. For the non-FI, some level of supervision is required. Stringent governance is inevitable. Primarily, if everything is going to happen so fast in the real-time payment system, if those control and process is not available, the systemic risk is going to be huge.
Yeah. All right. That's all. Thank you, Mr. Lim Eng Ail, for your closing statement. Now, Mr. Ahmad Dixit, please, the time is yours.
Thanks. Firstly, thanks a lot for giving me this wonderful opportunity to share my thoughts on what's happening on the insurtech side, insurance side. In conclusion, what I would say is that the insurance industry is undergoing significant changes driven by technological advancement, regulatory shift, and evolving customer expectations. So insurers must adapt to these changes and address emerging GRC challenges to succeed in this dynamic environment by changing or by adopting digitization, customization, innovation to stay ahead of the curve and provide a value to their customers. Again, as I mentioned when we were answering on all the questions and all, the insurance landscape continues to evolve, and it will be critical for insurance to remain agile, resilient, and customer focused to thrive in this competitive market. Thanks.
Thank you, Mr. Amar. It is critical to every company to create a good GRC system to avoid the risk and also the challenges we face in this era. Thank you, all our speakers and also panelists. For me, maybe to create a resilience GRC development and system, we have to look up again to the presentation of Mr. Nicholas Wood about the 3 lines of defense to create a risk appetite statement and risk appetite framework, which are set risk guidelines, independent audit, and also manage the risk, set risk guidelines, also independent audit. Yeah, we really wish that this session can be fruitful to all of us who attend this webinar. Thank you very much once again to all our speakers on this afternoon session. Mr. Wood, Mr. Lim Eng Ai, Mr. Ahmad Dixit, thank you very much to share your expertise with us. Yeah, distinguished guests, ladies and gentlemen, we would like to inform you that OJK Institute has launched the mini site of OJK Institute that will provide access to various information regarding the financial services sector, such as capacity building, professional certification institutions, and innovative and visionary research. For details, you may visit www.ojk.go.id/OJK Institute, or you may scan barcode on the Zoom screen to access the mini site of OJK Institute. Yeah. Committee, can you share the barcode maybe? All right, further, we can inform you that we have shared a link feedback form in chat, and please fulfill the link before Friday, February 24th as a requirement to get e-certificate. You may also access today's materials through the link that have been shared by us to the chat column and OJK Institute mini site on Friday, February 24th. The materials and recordings at the OJK Institute mini site can be opened in the capacity building menu, then choosing the role of governance risk and compliance, or GRC, in supporting financial sector performance webinar. Then materials will appear on the page and you can download it. All right, distinguished guests, ladies and gentlemen, thank you for 3,567 people who has registered and 2,550 people who has attended this webinar in the Zoom meetings from the banking sector, 44%, the non-bank financial industry, 29%, OJK 7.6%, academician 7.2%, the capital market sector 4.4%, others 4.15%, and government agencies 3%. We would like to inform you that the link of the feedback form and materials from speakers is available on the chat feature. Please complete the form before the webinar is ended as a requirement to get a certificate of attendance for today's webinar. Yeah, ladies and gentlemen, for the next week, OJK Institute will invite you again to join webinar Prospect Insurtech di Indonesia. Webinar Prospect Insurtech in Indonesia pada tanggal 2 Maret 2023. We have Ibu Dewi Astuti, Kepala Departemen Pengawasan Asuransi dan Jasa Penunjang IKNB, Bapak Teguh Arya Jana, Direktur Utama PT Asuransi Simas Insurtech, Bapak Cleosen Randing, Founder and CEO PT Pasar Polis Indonesia, dan juga Bapak Harsyad Lunani, Founder dan CEO PT Arkor Teknologi Koala. Ya, Bapak Tommy Martin. Baik, Bapak, Ibu, ladies and gentlemen, distinguished guests, we remind you again that OJK Institute is holding a call for papers activity called Charisma with the theme of 2023 being the impact of Act number 4 of 2023 regarding the development and strengthening of the financial sector, P2SK, on the duties and functions of supervision of the Financial Services Authority, with final deadline for writing admission on July 15, 2023. And OJK has also wants to inform you that if you love to read, you can use the OJK Digital Library or e-library through the link e-library.ojk.go.id. E-library provides various types of books that can be accessed by OJK internal and external. Inside OJK can directly access e-library by login using office mail and password, while for the external, you may first register your account through the register menu. Reading become easier anytime, anywhere through OJK e-library. All right, distinguished guests, ladies and gentlemen, we have come to the end of our today's webinar. On behalf of Indonesia Financial Services Authority, OJK, I would like to thank you for joining us today. We are looking forward to meet you again in the next event. Thank you very much and have a good day. Wabillahi taufiq wal hidayah. Wassalamualaikum warahmatullahi wabarakatuh. Om Santi Santi Om. Bye-bye.
Terima kasih.
Terima kasih Pak Agus.
Terima kasih undangannya ya. Terima kasih Pak Agus.
Terima kasih banyak Bapak Ibu.
Ketemu lagi.
Thank you, Mr. Mr. Nick Velasud.
Thank you, Aldi. Good job.
Thank you, Aldi. For all
Thank you,
speakers.
Mr. Ahmad, Mr.
Thanks, everyone.
Pak Agus, terima kasih.
Terima kasih Pak Ujang dan kawan-kawan.
Terima kasih Pak Ujang, Pak Agus.
Ujang,
Terima kasih Bu.